Good morning. It is July 14th. We're going to be streaming stocks, options, and futures trading today. Hope you had a good rest of your evening. Got about 5 minutes to open here in the market. Sub up, like up, comment down. Happy money sticks around. We have a Twitter you can follow us on at HappyMoneyYT, and a Discord server. Link for both of those are in the description. Excuse me. Also put a Discord link in the chat. Pin that. All right, thank you for your pre-market likes. All right, we've got some pre-market movers as well. We're at 9 likes before the bell. Well done, guys. Well done. Morning, Passing Cloud. Good morning, Molava. Morning, Christine. Happy Friday to you. Morning, Hugh. Got Negs up. I'm down a little bit. It's up 2.7. Nicola's up 23%. Yeah, I mean, it came into close with such strength. That's when you see these gap ups. Same with Neg, really. I don't think there's any news on this one. Eyes up 0.18. Not seen any pre-market for barbecue yet. Beyond is flat. GME is pretty flat. Mullen's up 6% pre-market. All right, 10 seconds. Here we go. Beef barbecue makes its move today. We're seeing 31 cents. Oh, yeah, now it's showing me. Barbecue up 3%. 30.90. $30.99 or 31 cents is kind of the top of that barcode range. See if it pumps through there. And SPY's opening up 0.2%. Morning Tasty. Got NKLA up 16%. Eggs up 8%. Dude. Search is broken. SPY ripping up here. Morning, J Souls. Zooms up 1%. All right, NEG, let's see it. NEG breaking the high, 16%. NKLA, 21%. There you go, NEG. Oh, broke that pre-market high. Plug Power's up 6. See if I can get filled on I don't know if I want to do some short calls on neg yet. Got so much potential. Gosh, I think my browser's lagging again. We should E-trade. What is it? Huh. Pop on barbecue, 5%, 31.49. $31.30. I don't like the lack of volume. NKLA breaking the high, 30%. %31% on NKLA. Getting the day traders in there for sure. A lot of volume. Very tradable. Rat is flat. Barbecue 30.90. It's up 3%. Carvana 6% on Carvana. Spies ripping there. Squeezy stuff still having legs this morning. 28%, 30% on NKLA. You're still holding puts? Might be. Beyond's up 6. That is neat. Lifts up 1%, but yeah, still looks good. Expect a rally on it any time. Egg kind of just consolidating now. Same with NKLA. GTI is waking up. 12.5 on that one. Mullen 8%. New high of the day there on SPY. Carvana 6. I like my neg. Balls to fill. I don't know if they will. Have to wait. What's gonna have legs today? My blink calls are up a little bit somehow. Weird, it's a tight spread even. Beyond back down to VWAP. Barbecue still holding up. 4.3%, 31.31. To have exposure over the weekend or not? If it doesn't just rip today, we might have a nice dip on it, being that it's Friday. Opened up a long on the yen futures. I'll be watching that some today too. Eyes coming down there a bit. That's still above VWAP. GME up 0.3. Barbecue 31.30 up 4.3. NKLA consolidating at 25%. And with neg, definitely like a resistance on neg here. A little bit, yeah. She's had quite the couple candles. Barbecue still hanging out at VWAP there. 31, 31, 4.3. Go, little pop, 31, 32, 6.6. There's 32.10, almost 7% on it. Or 32.50, it's up 8%. I don't know why, I don't feel like trading barbecue. Looking pretty good though. I mean, it has been since kind of broke out of this channel, but really just flattened out until today. Now we're finally getting a breakout to the upside. NKLA consolidating up here. GTAI still going 14%. Neg with some consolidation. Finger waking up too. Yeah, Finger's up 7. Beyond is up 8.5. There you go, Beyond. This is the way. Calls are only up 38%. You had a lot of premium on them, but I don't think I could have waited any longer. Yesterday was really the only day to buy it. These things are in the money already. Wow. Lift is up 1.3. Teladoc right at that resistance. Zoom right above it. Barbecue 32 cents. Had a little test of VWAP there. There's a candle on blink. The FLT up 1.6. New high there. To close that short position, I guess. Buy consolidating at the highs. Nickel at 28. GME's 0.5%. AMC's up 2%. Never got exposure on plug. Didn't like it though. They kind of rejecting there. Barbecue still 32 cents. Party City's up 8. Are you guys playing Party City? Come on, Nag, hold up. You can do it. Climbing some more. NKLA 25. Barbecue 6.7. Up 32 cents. Jan 1 is up 15. That looks nice. Anchor motion up 6.5. $32.02 on barbecue, up 6.7. Everything's maintaining so far. It's going crazy, crazy. Carvana's breaking out a bit. 9%. And 48 cycler ban. I mean, he was saying that for Wednesday, for Thursday. And that's just subjective. Maybe this is it. 6%. Maybe that's all it's needed. There was no specific percentages on that ban bet. Jumped into multiple risky plays, not able to exit. I mean, you can probably do it. You'll just get a good faith violation if you're out of day trades. Coin is just going crazy still. Oh my gosh. That is crazy. $31.99. Barbecue 6.6. You had 25K in a couple days. Give me a change to margin. If you're over 25K, it should automatically let you Actually, should never not let you. It'll just give you good faith violations if you're out of day trades. Nicholas coming down there. See if Neg can hold up. Still squeezing. Yeah, Mullen was running up too. Mullen's holding up 7%. I've never talked to Robinhood's customer service. Curious how that goes. Gosh, I really don't like Mullen. $0.32 on barbecue, 6.6%. Come on, Neg, you can do it. Eisen's up 10%. Oh, you can't do it. I wonder if Blink's gonna wake up. All the other squeezy ones are going. This one's in the EV space too. I like the chart. Pound's up 5.8. I wonder if I should leg into this thing. I'll leave it. Fallen 6%. Barbecue 666, 32 cents. Yen is still climbing a bit. Nicola's filling the gap a little bit. Jan consolidating. In with Neg. Go EV's up 12.5. Chart doesn't look too bad. Elon is up 11. Is this animal healthcare? What is this? Animal health company, yeah. How's Droop doing? Droop. Spy's coming down there. Well, big flush on Spy. Filling that gap. Oh my. Something just happened. The yen just started plummeting also. What the heck? Something just happened. Oh, 10 o'clock. We get data or something? What was it? Consumer sentiment? Market dumped on that. So did the yen. That's weird. Barbecue 32.25 up 7.4. 32.26, 7.5. Exit path plan is supposed to be out today. Borrow fee came back. Is it going to be in a hearing or just a docket or? Yeah, 144%. Not that high actually. It's increasing, but for it being gone for 3 days, surprised it's not higher. Or 4 days. Docket. Good morning, David. Good morning, Maui. There's no way to set up hotkeys on E-Trade on the browser. Probably have to use their desktop app. And some barbacoa in there on barbecue. Market reacted to that consumer sentiment, but the follow through. Low was up 4.5. All in 4.3 still. Nicola's come down a little bit. Still kind of filling a gap there. Oh, neg just flushed. Got filled. Oh, neg, what is it? I don't know why neg's flushing there, that's weird. Seems like something came out. I don't know. You guys seen any news on that? Neg filings? What is this? Securities to be sold. There's a filing here. Maybe someone just sold. I don't know. The form 144 says relationship to issuer's officer. Looks like Chang Robert. Only 3,000 units though. What, dumped it? I don't know. I don't know. .3% on Carvana. NKLA, little green candle there. Don't know what the sell off on neg was, but gap's filled now. That is neat. PacWest candid 8.5. Good for your cover calls, right? Happy Friday to you too, Kala. Beyond, I think I have got August. Yeah, I got just August calls. Not sure. Maybe need to refresh. I don't know why it's showing 720. Oh yeah, it is. What do you know? Not sure. It's normally 1080, right? Oh, maybe because Streamlabs. Since I formatted my computer, I wonder if Streamlabs went back to default settings or something. Whoops. I'll look at that. New high there on SPY. Go EV is ripping 27%. Barbecue's going now. 9.8%, 32.95. 33 cents. Eye of the day, they're on SPY and barbecue. Buenos dias. Puts on Carvana. Yeah, with enough time. Got a lot of premium on those now. Not sure about NEG. $12.5 on NKLA. 32.50 up 8.3% on barbecue. John's up 4 still. Lyft is pretty flat. Brad's down 2.4. Teladoc kind of rejecting that breakout so far. Nice bull flag on Carvana. All right, adding a play to the Theta Farm members. Opened one up today. 32 cents on barbecue, up 6.7. You know, around of VWAP. Bonjour, Benjamin. Gotta go EV. It's okay, you made money, right? Still going like crazy though, 31%. That's no good, Cameron. NKLA rallying back up a little bit. Still under VWAP. Ravana 8%. Cloves at 6%. Mullins at 6.5%. Close out, I might be on call. Gotta take some risk off. I might be back in at some point. It's pretty extended. I got it yesterday and I don't know. Next coming down here. Okay, I made the neg play free. High's coming down a bit. Link's down 2.5. OAB up 26. Nickel up 12. Barbecue up 8. 32.50. Ivana's coming down. Trying to look at where else I should de-risk some. I like lift, but oh, why I only got one fill on that? lot of volume on neg today. Wow. SPY's coming down a bit here. Still has a little gap to fill on it. That low of the day? I think so. Made $90. Nice. And he could be the squeeze starting point. Next coming down a bit. With Nicolette's filling that gap. Eyes flushing. GME also. A little bit, it's down 0.5%. Nicholas gap's almost filled. By beginning of descent. I'll blink down 4.25. AMC is now red 2%. Everything's kind of flipping around. Like everything reversed. Barbecue hasn't yet. Buy coming down some more. I didn't do any daily options yet on the SPY. Like any setups yet. Or the futures. Chopped around in here, lost some, but did end up getting to a short. I'm watching the yen now too. It has been moving a lot. Setting up some pretty nice trades other than when consumer sentiment comes out and it just flushes on that. Okay, I'll check it out, Cameron. Egg. Giving it back. Nickel almost red on the day. This is one of those days. Catch everyone's longs. Flip it around. Big reversal. Kind of sensed it. That's why I started closing some stuff. Didn't get out of everything. More flushy on the SPY. What? That's just funny what you shared, Cameron. GME down 1 1/4. Market is not giving any bounces yet. Beyond flushed. I got a beyond. Few I got a beyond. Blink flushed. Oh boy, 5 1/4. Steady downtrend here on SPY. I'm closing those shorts for now. I'm building the inverse cup here. If we get a handle. Oh, Jumia? Yeah, what's Jumia doing? It seems like everything just took a turn, so yeah, this thing's down also. Yeah. I mean, you had this RSI divergence, looks like that's what's playing out. We might be topping on this frothy rally we've been having. So I'm gonna tread softly. Market is kind of preparing for earnings next week, it seems like. Actually, how did the banks do this morning? Must not have done too bad. The market gapped up. Yeah, we'll just have to see what the market's doing. Okay, now I made my neg free. For Jumia. Yeah, I'll have to just see what's going on. I mean, it has an RSI divergence, so be patient on it. Could just be a Friday morning shakeout, but I don't know. This might be the end of a lot of the party. Party. For these ones that have been squeezy. Okay, another play for the theta farm. I've had to be very patient with these because a lot of the stuff that I was farming have just ripped. I can't really play it anymore. So trying to find stuff that's not gone crazy. It's at a pretty good level and it's bullish looking, but doesn't have to rip. Ugh. Barbecue flush down there a little bit. Below VWAP now. Buy looks like it might be making the handle here. Be patient. Could climb up to VWAP still. NKLA bouncing back up to VWAP. $31.09. Barbie's up 3.6, coming down here. SPY climbing back up. Quick Moaz. Hey, this could have been all. Who's to say this wasn't the move he was talking about? 6%. So I don't think it's spelling at 475. It all depends on time. Yes, I think it'll make it to 475. NKLA, it bounced a little bit. It's slowly coming back up to VWAP with the market, looks like. GoEV's held up pretty well. Yeah, I don't know. I don't know why he does. He traps himself with this TA. Yeah, I know what you mean. You're not. That's the thing. Like the TA, it works, but then you get news or the court hearing or whatever, and it just flushes and dumps. I mean, it's played out pretty good to track. Really, it's made different formations that have played out. But when the volume gets real low and they kind of just barcode it, you know, it's tough. But yeah, basically, you're right though. It's it's kind of a just. That's why some of the TA hasn't worked, because everyone's just buying the dips, because they're all just not as many people are trading it. So that's why it keeps dipping and then it just rips out of them, because people are just trying to get more, just trying to accumulate to hold through the catalyst, which could be good or bad. And that's kind of why I'm over trading it. Better question will go to 4754 goes 400. There's a better question. Yes. Yeah, I think it'll go. You're talking about new highs, new all-time highs? No. Yeah, I don't think we're gonna hit new all-time highs. I think it'll go to 400 before 475. I closed beyond call this morning actually. Yeah, I started getting out of some of the long stuff this morning. It looked like everything was kind of turning around. A little bounce here, but this could be a handle on this inverse cup. Gonna wait to see that too. I still like beyond the upside potentially, but if everything's kind of turned around, you know, there comes a time once you've like had squeezy stuff go on for however long, and then it all kind of stops. Not sure if that's the case yet or not with beyond, but yeah, it's extended. I got it yesterday, and the fact it was up today, I'm like, just wait. I'll wait for retest, better entry if I can get it. Closed out of quite a bit of stuff today. Some of my neg. Should have done this morning. Okay, it's climbing up back up to VWAP. Baba. We'll see though. SPY could be setting up inverse head and shoulders here also. Yeah, Baba's filling that gap. I should have paper traded these futures. I don't know what I was thinking. I always start with paper trading. Buy above VWAP there. Buy neg. That we were looking at. Sorry, you don't like neg. Next chart looks really nice. I have a position on it, so I'm looking at my other monitor. That's why I'm not cycling through these. See if SPY gets an inverse head and shoulders here. We might get a wake back up here. Link's down 6. Tell it up 2.5. There's like a Writers and Actors Guild strike going on. SPY climbing up. Up 0.25%. You should go strike them striking. Say you want to see Deadpool 3. This could still be a handle. Like exactly 50%. And for a little head and shoulders here to confirm. Or just a straight sell-off from VWAP. All right. And it's written back up. Suck again. There's a little stop loss hunt. Hmm. Yep. There, I said it. Get him. All right, might not be getting that handle. Looking now for big inverse head and shoulders. For some shoulder to build over here. Reap rally. Be off to all, well, yearly highs at least. Eggs inching back up a bit. See if we get stuff waking back up here. I check my browser. High breaking up through VWAP there. This isn't the height plays. It's probably going with the mega caps now. Brad. That's down 4.5. high, ripping up there. Making this inverse head and shoulders, it looks like. Taking along there. Might get some spy calls too. Okay, I got some 452 dailies. Wait, did I get 52s? Whoops. I got 52s. Okay, here we go. Hopefully we squeeze. Nice little Friday squeeze, huh? Do it. If Amazon's still down the Reaches series. I haven't seen Reaches. A lot to be worried about, Russ. Hope you did well in coin. That thing's had quite the rip rally. Did some cash secured puts down here on it. Nice safe play, but a move like this, man. Balls would have been the killer for sure. Lost half a foot in 8 hours. Oh man. We had a leak in our pool around the lights. It was slower than that though. Very slow. With salt water, it sucks when you have a leak because you're losing the salt then too. And then you don't notice because you just start growing algae. And your salt should have been fine because you don't usually really lose any salt. Then the last thing you check is your salt, and you're like, why are your levels low? And you add salt. And then you start growing algae again. You're like, what's happening? I just added salt. Then finally you check your salt again. It's low again, and then then you have a leak. Ours was slow enough though, like you couldn't hardly tell. It was like just a little bit more than evaporation. I thought it was just evaporation. Weren't getting rain either. Just leaking around the lights. I think, I don't even know. I pulled the lights off and caulked or whatever. Did the water weld that stuff. There's like very small leaks. A couple of screw holes, and then I think where the wire goes in. Pretty common to leak around your lights and your filter baskets, like skimmers. Alright, Russ. See you in Valhalla, man. I'll take some off at probably 451 or maybe a little bit higher. And I'll stop out if we break VWAP. What am I playing? Oh, Jack Reacher. I watched some of that. I didn't really like it. I don't know. Kind of picky with shows. Let's see, I got 8, I think. Yeah, I got 8 of them. I meant to get closer to the money. It was just, yeah, I thought I was just getting one strike out of the money. Yeah, 5's good. Like I said, I'll sell some at the high of the day. Where we go? 452.14 is like the next resistance. Nice to have a couple that are free that you can just leave the whole day. Get those late afternoon pumps, power hour pumps, 10 minutes of Fugazi pumps. Fun to have a couple on a day. Only if they're paid for, though. It just break VWAP, didn't it? It just needs to build some liquidity before it keeps going. Did have just a straight up rip through VWAP pretty much. It is just wicking below there, which is fine. That is an engulfing candle on the 5-minute. But it's hard because they're right at VWAP, where directions are decided. Or just stays there. Oh. I'm not just gonna hold these and hope. They could go back to green, but I need to respect the plan. This is kind of right in my cutoff, though. Let's see. Body's up 6. GME's down 1.5. Eggs kind of climbing back up. Yeah, I'm jumping out of those. I don't like it. Still have a long on the futures actually, which I might cut those also. I don't have time decay on those, so I can kind of sit on them. SPY did hit the yearly high this morning. Nice, Russ. Thank you, man. Appreciate it. Glad to hear. Hey, Dink. Yeah, that's the thing with opening positions at VWAP. The safety line. Morning, Guts. August 1st. That could cause some market reaction. Alright, I'm closing those futures. Wait for a better setup. I don't like it. I don't like the 5-minute engulfing. MACD never flipped, stayed bearish. Could be setting up a little inverse head and shoulders here, but I'll have to wait again for the shoulder. Have a little head and shoulders right here even. Be patient. Chop. Retards are buying calls for 5 cents. Oh, puts for 5 cents. What, on SPY? Glad to hear, Alex. I don't feel like trading should be exciting and calm at the same time. Exciting, but you shouldn't be trading like excited. You're trading very calm. Jeez, now we're just choppy. Next up, 4%. Blink looks like it's gonna start bouncing up to VWAP. Points up 1%. Rad down 4.25. Black come down here. Yeah, the head and shoulders pop through VWAP. Failed this bigger inverse head and shoulders. Went back short on the futures. So you're welcome to rip. Need this right shoulder to hold. OEB is held up strong. But FI's up 5%. TBLT up 3 1/4.
Let's get nuts!
Let's get nuts! Thanks for the donut, gods. I appreciate it, man. Appreciate the generosity. Are you on our Discord? Might I interest you in a Discord? Nothing but the bangers. Appreciate it, gods. Thank you guys for your likes also. 2 minutes to noon. Yeah, jump in the Discord. You might like it. It's pretty low key. I mean, we just chat kind of about whatever. I mean, a lot of finance stuff, but it's a pretty good resource actually. A lot of trading tools, and when our bots are working, a lot of news. Twitter bots. That's true. UPS, is it already getting dumped on? Well, I'm surprised it hasn't come down yet on that news. Mint money? I didn't mint any money off AMD today. Oh. And this Head and Shoulders maybe now failing. So far we're just caught in the chop. 12 o'clock. Chop caught. Video's up 2. Ops is up 2. Had to close TBLT this morning. Might have been a good idea.
Let's get nuts!
Let's get nuts indeed. Thanks, Ace. Appreciate it, man. It's free but no music. Chill tippers? They paid a shill? That's funny. Sincerely, BlackRock. I knew Ace was from BlackRock. Appreciate it, Ace. Thanks, guys. Yeah, SPY's literally just between head and shoulders and inverse head and shoulders, just right at VWAP. No good setups. You gonna make your mind up here? RC connections. So a shill, they tip and tell them to say something. Shill, that's what it means, shill tippers. Or they're just tipping so that he'll read it. And they're trying to spread FUD. Pay to tell him if plays crap. Yeah. BlackRock. BlackRock will pay. We'll make him pay with tips. I'm trying to figure out these. These yen futures. It doesn't. I don't know if it's a huge spread or. I don't get what's going on. paper traded. It doesn't make any sense. Like one of these trades I know I did well, and I think my open and close price was the same. Just because of the spread? I'm just not reading it right. I don't know. Sell Bobby. Yeah. That's awesome. What a gift. Here it comes. If you break out of this chop. So we should be expecting a docket on barbecue today. Is that right? Which might have a lot of answers. And we'll probably see reaction on the stock. So it has no answers. We suck again.
As you were mentioning, you had CPI and PPI come in, under expectations. And then you had consumer sentiment that was fairly strong. So, things had set up pretty nicely for equities this week, and you've seen that with their performance. I think, have we gone a little too far, too fast? I don't know. Time will tell on that one. I do look at some of the breadth numbers, though, and those have improved.
Bouncing off this support down here.
Ahead of themselves. Just looking at the S&P
Let's buy.
in particular, we've been talking about this fact that it's been a narrow rally, and we wanted to see some of that underlying breadth improve. Well, now you have about 83% of the S&P 500 stocks trading above that 50-day moving average. So you've seen that breadth, you've seen that distribution, and that supports, this rally at this point. NASDAQ's improved as well, too. Not to the same extent. You got about 56% of the NASDAQ trading above its 50-day moving average, but only about 42% above the 200 days. So it's still a little bit more shallow there. We've seen some improvements for sure in the Russell and the small caps in the last couple of weeks. And so you're starting to see a little bit more of that distribution of that breadth, which I think is kind of helping this rally and potentially gives it a little bit more in terms of its legs.
Yeah, you mentioned that, stocks in the S&P 500 trading above their 50-day moving average, about 82%. That's, towards the high end that we've seen over the last 52 weeks. Kev, when you look at this market and you look at that consumer sentiment data, some of the inflation numbers, the 1 and the 5-year inflationary numbers, kind of firmed up and reversed a little bit. Does that set the tone for maybe month-over-month?
It might not be on there though, right, Cameron?
With this wealth effect that the equity market's creating at this point, home prices at or
Maybe
near
it's
record
redacted
levels,
or
not coming down anytime soon.
pushed back
Does
on
that,
dates.
Warrant the valuation that we're seeing in the S&P 500 as far as forward-looking PE?
No, it doesn't. It's pretty simple. I mean, I can get the fact that the market is firmed up and moved higher, but like you and I talked about, Tom, when you're up at these levels and you really can't think of any inertia to get the market to go down, what usually makes the market go down is something quite simple and quite light, right? It doesn't take much
That's true.
to turn the market around. The fact that some of these financials are down on their earnings should be a bit alarming. Why? Because what they said is net interest. Look at the income we got from net interest. Well, interest rates aren't going to go up 500 basis points in the next year. So you can't really count on that kind of windfall from net interest margin going forward. So so this market, in terms of the firms that are making money, like AI, right? Is AI going to do what it did in the first half of the year again? It might. There's a chance. I would call it low probability. But the banks aren't going to do as well. And there's just a bunch of reasons to pause. And Nate had a great comment on yesterday's show where the current PE is of the S&P 500. It's tough to sustain that over a long period of time, guys.
Yeah, and kind of expanding on that conversation there, Joe. When we've been in these markets,
letting the shoulder or the neckline go.
And
it's little head and shoulders.
The ups and downs, and things can get
Here's the
overbought,
neck.
oversold. But I always look at the valuation
for a low
to
day.
earnings. Now, earnings are expected to be a lot better than maybe the street anticipates at this point, because some of those expectations have come down, and that typically happens. But when you see that forward-looking PE as high as it is on a historical basis, and is this going to be a
crazy
show me story as far as earnings go?
So this is it today, Cameron. Today's the day, Cameron.
I want to hit a couple points real fast.
Make it or break it. But it might come after hours, right?
FactSet has it around -7.2% coming into Q2. It's a pretty low bar to beat. So, if we see anything like we did in Q1, where it's about a 50% beat of earnings, the rally can continue. The other thing is, even with a PE around 19, forward, a lot of that has to do relative to inflation, right? I mean, if we're still talking about 4 or 5, 6% inflation, absolutely, that seems astronomical. But as inflation starts to wind down, if that continues down that path, then it can be supportive of those higher valuations going forward. For me, the key is going to be the market's reaction to the beats, right? You pointed that out today, Kevin. I thought that was a good point. You would expect pre-market the beat that we saw in JP Morgan to kind of carry forward. It hasn't. It's pulled back a little bit, but the stock also rallied, pretty steadily going into earnings as well too. And we've seen the rally in the market heading into earnings. So I guess the question is, will the beats be significant enough to carry that rally going forward? I think ultimately, that'll be the catalyst that either moves the market up or down, because we've got the next 4 to 5 weeks to figure that one out.
Yeah, Joe, real quick here on, the Fed's Waller came out with some commentary last night at a dinner where he basically kind of laid it out. Well, hey, we're going to do 2 more hikes. He might have been that dissenter last meeting as far as not doing any action, even though they got the unanimous vote. But when you look at that, is that maybe a potential catalyst or impact that investors and traders should be watching for? Is if we do 2 more, because we've got a healthy economy, that the pain trade as far as rate hikes isn't over?
Well, I mean, I
until
think if
midnight.
you look at the market
Crazy.
expectations and the Fed funds rate, they're kind of, they're pricing in 25 basis points for sure, right? There's a little bit of a mixed
I'm
reaction.
not sure if I want any
we'll get
exposure
a
for this
50 basis
weekend.
point hike over the next two meetings here, but spread out over the next two meetings is what I mean. So that, there's not as much consensus there, but there's a real strong consensus of a 25 basis point hike. I think it's 92% or so at this upcoming meeting. It's really September and November where there's kind of that indecision. I think it's around 50-50 there. The markets, I don't want to say they're comfortable with that, but if you look at the difference in between expectations now relative to where we were, say, even a few months ago, where there was a lot of expectations for cuts in the second half of the year, that just keeps getting shifted back and back and back and back, in terms of time. And it's funny because when you look at the relationship between the cuts and the relationship between expectations for a recession, both of them keep getting shifted back and back and back. So now expectations for a recession aren't until 2024, and expectations for cuts, there's a small expectation for a cut in December at the end of the year, but a stronger likelihood of a cut in 2024. We are probably of the mindset here that we think it's higher for longer, and I think that markets are still a little bit too optimistic in terms of the cuts. And just be careful what you wish for, because I think what would precipitate that cut, that would be some weakening in the economy going forward. And so it's really the labor market in our minds that you should be paying attention to for that.
Yeah, I like that that thought process of rate cuts, because Kevin and I and most of the people on the show, we've been laughing about that just 3 months ago the market was expecting 1 or 2 cuts before the end of 2023. So little FOMO trade may be going on here right now to the upside as far as equities go. Hey guys, let's take a quick break. When we come back, we're going to take a look at one of the big tech winners so far this year, and that's Microsoft. Tech giants near all-time highs, up 46% so far in 2023. We're coming right back.
Head and shoulders playing out. Did we get the low of the day? Hey, Jonathan. I'm melting down some more here. They have an inverse cup and handle now. Guess you could say this was the handle, but that was a pretty deep retracement. But yeah. Still melting down here. Barbecue's not breaking out, Russ.
Right now is they're trading really heavy call skews, meaning people are paying a lot of money for those calls relative.
It never dipped. RC never sold. Filings were fake.
They're both trading at about the same implied volatility. That doesn't happen very often. And what that points to me is some of that FOMO trade.
You would never do that to retail.
Missing out, where people are paying up for some of that upside. And when I see something like that happen, I like to fade it a little bit and maybe take the other side. And what I did here is I sold the put spread instead of buying the call spread. Even, you can still have that bullish bias, like by selling that put spread. But what that does is it gives me a little bit more cushion to the downside should the stock pull back, as opposed to paying up for those calls, which I looked at as relatively expensive right now.
Yeah, the VIX was actually higher yesterday, even though stocks moved up to the upside, and I think it's because people reaching for speculative call purchases at this point, because as calls go up, so that VIX can also go up. It's not just the put side, but let's break this one down. August 4th, weekly series, 21 days till expiration, selling the 330 put, buying the 325 put, short neutral to bullish, $5 wide put vertical. Cav, collecting a buck, you got $400 in risk. Break even.
Oh, Friday.
The probability of that short 330 put finishing out of the money is over 72%. Your thoughts on the short put vertical?
Yeah, well, this is a short put vertical that will encompass the earnings release. In that, like Joe said, if you go out to August 4th, the expected move is about $24 plus or minus. So, therefore, that trade-off is that $24 brings you down to about $323, something like that. So that's inside the expected move. Now, that doesn't mean this is a bad trade. That means that Joe has used that trade-off to collect more premium, via moving those strikes closer to at the money. If you're bullish or passively bullish on Microsoft going into the end of the summer, remember, you've got $17 on the downside, and then whatever, a dollar credit. So you really got $18 on the downside before this put vertical starts losing money, Tom. So you've got plenty of room here. These stocks can move, but this is one of those passive way, high probability way to play this trade, Tom.
Yeah, that
volume must be pretty low today.
328. It hasn't closed below.
Wait, is that rebalancing coming today?
In 6 months. So
I'm gonna see some crazy end of the day stuff if that is.
All right, great stuff. Great look at a short.
They don't need to make a withdrawal. When he does, I'll be sure to remember what you said, AC.
That short 330 strike put. And thanks to Joe Mazzola, Director of Trading and Education at Charles Schwab, for joining us.
Joe Mazzola.
But coming up after the break, Kev and I will be joined by Andy Swan from Lifefolio for a discussion on
Stop looking at me, Swan.
Rallied over 80% in 2023. Stick around.
Probably look to go long at the low of the day, or handle to form. Unless I get front run. Yes, he is trolling. Is he? Comment was ridiculous. Low up 7.25. ETOO's up 6. Well, I got front run. Now looking for a handle. $450.24.
Right, Andy. I believe that the Uber Lyft heavyweight battle is now over, and Uber's the clear winner. They're now 8 times bigger, which gives them more cash to spend on things like advertising and research. But, you know, if you look at the 1-year chart of Uber, and you see $20.59 is where it was
Barbecue
like
holding?
a year ago today.
I don't think it's gonna
And
hold
this massive
Friday.
rally that got them all
Unless
the
we
way
get that
up
docket,
to
it's bullish.
their IPO price, their original IPO price. It took them
But
all this
who
time
knows?
to get
It is kind of
back
in
to
a
there.
breakout area, so maybe it rips.
There's one little victory, right, that they got. But this is a company, if you put up like a 5-year chart that shows you the high of 64 and change and the low.
Volume today is
What
low.
you see across that
Also.
bottom in terms of earnings is a lot of negatives. A lot of quarters where they lost money, one after another. And so at some point, something's got to give. You're right. I think the momentum is on their side. I think they somehow made it through the pandemic, and all those things are going back up.
Talk about the price till the end of the magic show.
And put on your CEO hat for our viewers. How
On
do you
coupons.
get this company profitable? Is it the elimination of drivers?
Yeah, you know, I think they can squeak by a profit, you know, once they stop investing in research. So I think they could be profitable really quickly if that was their goal. I think they could stop investing in a lot of the research they're doing, a lot of the advertising that they're doing, and just run on the momentum that they have as being, you know, the #1 ride-sharing app by far, and right up there in terms of food delivery. I think they could run a really nice, profitable business, but I don't think that they're satisfied with that. I don't think they ever have been. It's always been about growth, and it's always been about this vision of having, you know, autonomous vehicles taking people and things all around the country in a, you know, in local fashion, that kind of literal last mile of delivery. I think they're nailing that, and I think the technology is getting very, very good. You know, in terms of, you know, driverless cars and getting rid of that 30 or 40% of the cost of every ride, I don't know where to place the bet on that. I think, you know, the truth is probably somewhere in between what Elon Musk thinks and what, you know, the naysayers that want complete government regulation think the truth is probably in the middle there. But once that happens, there's only a couple companies that are ready to take advantage of it, and Uber is definitely one of them.
Yeah, Andy, they just announced a partnership with Domino's. They're going to start delivering through their Uber Eats. It seems more incremental to and helpful to Domino's than it does to Uber. Your thoughts on that? And I know earnings aren't for about 2.5 weeks. Do you have a score for us?
Yeah, I think right now we would have to be slightly bearish on Uber going into this earnings report simply because of the massive run in the stock. Things feel quite a bit extended. We think the company's doing good things, but not that great. In terms of the Domino's partnership, I just think it's just another signal that once Domino's waved the white flag on having their own app, exclusively through their own app, exclusively through their own delivery drivers, that it was Uber that they went with. I think that's more the signal to the market than anything that Domino's chose Uber is probably just another indication that Uber is the company that, Fortune 500 companies can trust and that consumers are becoming really addicted to. So I think that's more the story. I do agree with you that it was better play for Domino's, is long overdue for Domino's, but for Uber, it was just they won and DoorDash lost that deal, and I think that's at least a little bit of a signal to the market.
Yeah, and it also might signal more partnerships coming down the pipeline for Uber Eats also with some of these big brand names. All right, great data. As always, Andy, appreciate it. Have a great weekend.
You too. Thank you.
All right, that's Andy Swan, co-founder at Likefolio, breaking down the
Stop
data
looking at me,
for us.
Schwan.
Now Kevin's going to break down his example trade here for us in Uber.
Guys, I looked, they have earnings on August 1st before the open, so I wanted to stay ahead of that because that could spark some big move. But what I did, Tom, I did a combination here. Something in, I would call it the Iron Condor family, but I'm missing one leg, Tom. So here's what I did. I sold a cash secured put. I sold the 43 cash secured put. And every trade I did here was in the 28th of July. Against that,
the handle,
Tom, I
done?
sold the 46, 48 call vertical. And so for the next couple weeks, I collected about 90 cents on this. And all you're looking for here is to stay in that range. It's got a little bit of risk.
50% would be VWAP.
$110 if you sell it for 90 cents. And you're looking for a range between now and earnings in between 43 and $46, Tom. The risk, like I said, on the upside is only $110. On the downside, of course, you have a cash secured put. Very small premium name here, as you know, Tom. Not big, premiums on the option. So using that cash secured put, if you would buy the stock, it would be, 42.10 would be your entry point on the downside, Tom.
Yeah, let's break this custom three-legged spread here where you're selling one of the July 28th weeklies. These expire in 14 days. Selling one of the 43 strike puts and then selling a 46 strike call, buying a 48 strike call for this customized three-leg spread. You're collecting a credit of 90 cents. So there's your profitability between 42.10 on the downside and 46.90 on the upside. Kevin mentioned $110 in risk to the upside if it goes above that 48 level. You've got to be prepared on a strategy like this to own the shares if it falls below that 43 strike. Your purchase price on the shares, if you get assigned 42.10 on that. So that takes your risk on the downside if for some reason the stock went to zero, $4,210 required on that side of it. But a good look where you avoid earnings, because I think that was one of the key takeaways from Andy Swan's assessment here is the stocks run up really far. This trade, this example, avoids that earnings event. You do have some assignment risk, as I mentioned, on the short put, and then also on the short 46 strike call on the upside into expiration over the next 14 days. So real short-term positioning on this example trade here. But what you probably need, Kev, is just some consolidation, right?
Exactly right. Just a
Little
kind
pop
of
there on
lateral
barbecue up to
movement
VWAP,
into that
31.90.
earnings or gearing up for that earnings play. Before
Up
that earnings play
6.3.
come, we're out, Tom.
Yep. All
you guys
right,
keeping an eye on the
have a look at
dockets?
That example, customized option strategy, 3 legs. Got some transaction costs, no commissions. All right, coming up after the break, we're going to take a look at Oracle, which is pulled back from last month's all-time highs, but it's still up over 45% so far this year. Fast Markets coming right back.
Up, up, up. A little bit of pop. Just a pop to VWAP.
Give us a market update. Happy birthday there, Benny.
Liechtenstein's birthday?
What are you seeing here in equities?
They are, Tom. It's good to be 45 again.
Boy.
SPX here up to 45.27 today, Tom. 3 of the 4 majors
This
in
guy.
positive territories. We head into the end of the day. The only one that's actually negative is the Russell. The NASDAQ topped out at 15,720 and the Dow up to 34,592. Now, the the Russell, I meant to say a bit of an outlier here, traded down to 1920, and you can see it down on the day by 1%. But, you know, I think this is just the market trying to digest what's been a very big week to the upside and a win for the bulls in many ways after the inflation data. Today's kind of mixed price activity comes after Michigan sentiment coming in much better than expected. That sent yields back up here, and well, the banks, obviously a focal point as well, with 3 of the big names reporting today, and strong results for the most part across the board, setting a very positive tone and a firm foundation for the focus next week, which is going to be primarily on earnings here, Tom. So again, 3 or 4 majors in positive territory as we head into the end of the day, just kind of taking a bit of a breather after a very busy week and a big week to the upside.
Yeah, Ben, real quick here on the dollar, 6 straight sessions of losses, hitting significant levels we haven't seen for a while. It's starting to firm up here a little bit. Your thoughts here on the dollar?
Yeah, this week down to 15-month lows here, Tom, and
Holy flush. Had a late entry on that. Was waiting for that handle to finish. Jeez.
Rates recently, I think you can chalk it up to some of the strength we've seen in the foreign currencies like the yen, the pound, the euro currency as well, all across the board.
I was meaning to set a hotkey today too, and I don't think you can on the browser.
Here you can see
Now we're right back to where I should be closing the short.
Recovering off the lows we saw this week, but still hanging
We'll see
out
if
right
it
around 99.
bounces here or keeps going now.
All right, great stuff. Thanks for the market update, Ben. Hey, 70 years
Putting up an
old
engulfing
looks
candle,
good on you,
too.
buddy. Keep that in mind. All right, thanks to Ben Lichtenstein, host of the Future Show here on the network. But now let's bring in George Tillis, senior markets correspondent here on the network. George, we're talking Oracle. And we talked about Uber on the last block with Likefolio, but Oracle seems one of those stocks over the last couple of years. They've re-rated this name also as they make their push into the cloud, right?
They are. I mean, this is really an interesting situation. I mean, first off, from a top-down view, when it comes to artificial intelligence, everyone thinks about NVIDIA because they're just gaining access across the board in both public, private cloud data centers, and everything associated with artificial intelligence and discrete graphics. But you got to think about private cloud infrastructure, and that's where Oracle actually really shines. I think, people think about AWS and Google. You got to think about the public cloud and also ChatGPT, which is OpenAI. You have to think about security and, of course, closed source artificial intelligence and the host services in the cloud and companies that provide that. That's Oracle. And I think that's one of the reasons why we've seen such a nice move in the stock over the last year, considering, again, the reported earnings, which were actually very good when they posted them back on the 12th of June. If you look at the breakdown, the company is generating significant not only cloud-based revenue growth at around 54%, but infrastructure services. And that includes the hybrid component of both their traditional infrastructure or enterprise ERP resource planning software, their core enterprise software, which is really the backbone for corporate enterprise software. But at the same time, they're integrating infrastructure as a service, which includes cloud and artificial intelligence. And I think you think about the major Fortune 100 or even 500 companies that utilize Oracle, which is pretty much all of them, they all want to have some sort of private cloud access with artificial intelligence that's secured. And I think this is a really big growth story for Oracle. It gapped higher on earnings, pulled back to the 114 area, and since the beginning of
SPY,
this
wow.
week, it's been up 4 consecutive
Bouncing
days
off the
across
lows there.
the tech sector.
Dang, dude.
George, this is a name that was mainly thought of as like
Holy
old tech,
wick.
right? It's been around for a while. It wasn't a major player. It's
Still an engulfing
slowly
candle.
but surely making that transition to the cloud. What is it? What's the big growth? Is it AI? Is that them getting involved in AI? Or is it them finally starting to show up in the market share business of cloud computing?
I think it's both. I think if you look at the breakdown, which is pretty interesting, and you're right, this is traditionally a legacy software company.
Maybe just did the cup handle and just completed the handle, and now it's done. I don't know.
3%.
That was weird.
Earnings growth around 4 to 4.5%. So that's why we saw essentially sort of a steady
Bulls more control
let's
back.
call it. But since this past year, you've seen growth in sales just move pretty much exponentially. The estimates for revenue growth for Oracle, and this is the consensus, is around 11.5% on a forward basis. So that's about 3 times or 3.5 times their 5-year average. So what is that? That's really a function, I surmise, of their
Rip sooner or later.
their enterprise resource software, which from a licensing revenue is not generating all that much revenue growth, but it's a cash cow. It's generating stable revenues and stable cash flows in which they're utilizing to make investments to expand cloud infrastructure services and artificial intelligence. You got to think about Oracle and the integration they have with
ripped. It's up 5% today.
licensing software and enterprise resource software alongside cloud infrastructure services. And businesses want secure, reliable access to the cloud, but also integrated artificial intelligence. And I think that's really where Oracle is shining. And I look at this as really a stealth AI play, considering the traditional elements to its legacy business on top of the growth associated with artificial intelligence.
Yeah, you bring up a great point. They're spending billions, Larry Ellison, CEO, billions of dollars on chips from NVIDIA to kind of build out that AI infrastructure. And George, they've already got all the clients across the globe.
Oh, I got
Most
stopped
of the
out.
Fortune 500 companies are already customers of Oracle, so this seems pretty seamless So maybe some of these outsized gains warranted at this point. Yeah. All right. Great stuff, George. Appreciate it. Have a great weekend. That's George Tillis, Senior Markets Correspondent.
All right, guys.
Here.
You too. Thank you.
Thanks, George. Kev, I'm going to kind of get to the trade right away because George mentioned that the pullback that we saw from 127.50 just about a month ago down to 114. This is post earnings. Pretty good report, and their outlook was really good. They're controlling some costs while spending where they know that they're going to make more revenue. So I looked at a strategy. They don't have earnings in probably until mid-September, but this might actually capture that earnings once they come out with a specific date for that earnings released. Last September, they released earnings on the 12th, so this might capture that earnings, Kevin. But I looked at just a bullish call vertical where I can offset some of my costs by, instead of just buying the outright call that's at the money, sell something out of the money against it just above that all-time high. So I looked at going out to the September cycle, so just over 2 months till expiration, buying the 120 strike call and then selling the 135 strike call against it. You're paying roughly about a 440 debit for that. Markets have come down a little bit, so you might get a little bit cheaper. But if you pay a 440 debit, there's your risk, $440 per spread on a spread that can expand to $15. Good risk reward setup if you're bullish on this one. That break even 124.40 over the next 63 days. Kevin, your thoughts here on a directional bullish play, but you're giving yourself some duration and potentially capturing that earnings event also.
Yeah, if you look at the chart of where it was, it hit 127 and a half. Like I said, this puts you right in the middle of that and profitable if it gets back up to all-time highs. Yeah, it's trading about $4.25 right now, Tom, which would be 3.5 times your money if you're right on that. That's the great thing about the vertical. You do need some movement. That's the trade-off on a long vertical, but if it does, you get paid exponentially, Tom. So you're paying a little theta. You've got about 35 deltas on this, but you've given yourself all the way out till September expiration, Tom. Any move towards over 124 and you're profitable.
Yeah, and implied volatility at or near 52-week lows. So buying directional verticals are going to cost you less money when option premium is contracted a little bit. Kev, I wanted to get your take here. What are you looking and what are you focused on next week? Got a lot of housing data, and we got earnings starting to pick up again next week. What are you focused on?
Well, obviously it's earnings season. The data for next week is light, although we do get retail sales out next week, so that'll be the big look at the U.S. consumer. Yeah, you're right, a lot of housing data. But yeah, Tom, it's earnings season now, so this big market is going to be made up of a bunch of little stories about earnings. And you saw good earnings today and muted reactions. Let's see if that carries through to next week.
Yeah, that's a great point. Have the gains already been built into a lot of these companies, even if they beat at this point? That's a good way to look at it. Netflix, Tesla earnings next week also. Those will be key on Wednesday, along with United Airlines. All right, that's going to do it for Kevin and I today here on Fast Market. Stick around, though. Next Gen Investing's coming up next.
Mullen almost right on the day. Nicholas still up 2.5. Five, almost 10%. Getting close to the low of the day. I have to close back out. All right, we're at 27 likes on the day. Well done. I guess we can get news on barbecue at any moment. One o'clock. It's slow.
But it's been a
Next,
great
Jenny.
week for investors. Huge moves to the upside. NASDAQ just continues to power higher. A little bit of weakness in the Russell, but
Twice
not
the
every
recommended
day can be,
depth of water.
A green day across the board, but
Ocean
objectively,
Gate.
and we're using that word, objectively, it's been a really, really good week for investors.
It has, and I think I could only find a few names we're talking about that haven't made pretty major gains on a week-to-date basis, so lots to get through today. We'll kick things off here with our upvote and downvote segment. Following that, we will chart and trade those upvotes. Our FOMO discussion today is all things Amazon's Prime Day, as it did mark its largest single sales day ever. We'll discuss more what the analysts think of Prime Day later on. And then we will look at Spotify pacing to gain 10% this week as analysts update their coverage here to the upside. Last but not least, we will look at our under 30 name, which is Plug Power, Northland Capital upgrading shares. Another name making a sizable week-to-date gain.
Yeah, we talked some Plug Power earlier in this week, so excited to get more in depth on that one for under 30 today with George. Spotify is always a fun conversation, but I know we're going to spend some time on Amazon, but I got to ask, because you always talk about sort of this retail fever that you'll get from time to time. Did you find stuff on Amazon? Because I didn't even remember that it was going on. We've talked about it a bunch. I think I went to the Amazon Go store that we have in the lobby of this building and got some M&Ms. So I guess that's where I contributed.
You did contribute to their massive sales day. I did, but I needed things anyway. I don't even think they were on sale, but so I did partake in. I spent too much money on Amazon on Prime Day.
As is tradition, right? But we'll
Here's the low of the day.
part of the show.
Actually
Up,
close my
down,
shorts.
Go there. Not
I was about to
endorsements, not
bounce.
recommendations, of course. A little bit of a home
Flushing a little
theme
lower.
today. Things that you'll need. You get a new house, maybe a home builder builds it, then you got to get some of the stuff at places like Home Depot or Wayfair. And then if you need internet, AT&T can help you with that. So that's going to be how I tie all of these together. But let's kick it off with the home builder itself in Lennar.
Lennar, okay, so Lennar did touch new 52-week highs earlier in today's session. It's up about 1.7%. It's had a really nice year, but actually, comparatively to some of the other names in this Raymond James note, it's one of the worst performers, up only 45%. And again, it's all relative. We are seeing Pulte Group up 70%. So some of these names
You
have
said
gotten some
Pulte.
serious strength as of late. But Raymond
She actually
James
said
did
Pulte.
upgrade shares to outperform from market perform, set a price target of $150 a share, which does imply some pretty significant upside to where we're currently trading at around $132. They did also upgrade KB Home and Pulte Group also to outperform, saying
That's
this
how I would
level of
naturally
demand
say it, but everyone
and
says, no, it's
single-family
Pulte,
homes
Pulte.
warrants the upgrade. They said to that end, they have belatedly come to the realization that the magnitude of pent-up demand for single-family homes, coupled with the proven resilience of builders' de-risked operating models, now warrants this refreshed valuation approach. Now, Lennar specifically does have 12 buys, 9 holds, 2 underperforms, and no sells. Again, this name has slightly underperformed the group, but I think that considering it's still up 70% over the last 12 months, it's been a relatively strong performer in what has been a challenging home environment. I do know from so many of my friends that are looking to buy their first home, it is very difficult. It's like homes are just going same day they're listed. People are buying in cash. It's a very, very competitive market right now.
It's pretty competitive if you want to try to find somewhere to rent as well. But what I found just fascinating when it comes to this conversation in particular with home builders and them as publicly traded underlyings and stocks is looking at Lennar. It has made a new 5-year high, probably all-time high, I guess, if I zoom out here. If you would have told any type of market participant that interest rates would be at 5% on the risk-free rate, they would not have told you that would have been beneficial for a home builder. They would have told you the exact opposite. Yet, in fact, look at this chart. It has done everything differently than what the textbook would maybe tell you it should do. And it goes to show just how out of sorts the supply and demand for housing has been. And these companies just can't build enough houses to meet the demand. So throw out the interest rate conversation until that gets sorted out. But so impressive, this rally in Lennar. But say you do get, or you are one of those lucky few that is able to get a home and it's built and you're moving in, maybe need some appliances, maybe Home Depot can help you out.
And perhaps Home Depot and Lowe's reflect more of some of the trends that you'd think you'd be seeing in home builders, because Home Depot has had a relatively lackluster year. Shares are pretty much now unchanged on a year-to-date basis. We have risen about 4% now week-to-date, but still down about 9% off of their 52-week high. Lowe's looks a little bit better, up about 15% this year, but again, not seeing the same degree of outperformance that these home builder stocks are. Truist today, though, did raise its price target on Home Depot to $348 from $318, keeping a buy rating. They did also raise their price target on Lowe's to $249 from $229. And part of this broader note on home improvement stocks, the firm said that recent housing data continues to highlight further declines in inventory, which is helping to support some of these elevated home prices. Exactly what we were just saying, Alex. But with these dynamics, they said, driving incremental home investment activity and continuing to improve, investors may become incrementally more bullish on the home improvement sector. Now, when looking at the analyst coverage on this name, 22 buys, 15 holds, 1 underperform, 1 sell, but average price target at around $315 is well below this $348 level from Truist today. So they see this perhaps as a buying opportunity given some of the weakness we've seen for the first 6 months of this year at Home Depot.
All things considered, Home Depot has been pretty impressive considering this is like the ultimate sort of bullwhip, reverse bullwhip effect in terms of supply and demand of the products that it sells. During the pandemic, this is a story that is not new to anyone. We've talked about this probably anytime we've talked about Home Depot or one of these names or a lot of the tech names as well. so many, when at home, realize, that office space that I'm suddenly in a little bit more needs a little bit of a fixer up. Or, I don't really like that couch that much. Now that I'm home a little bit more often, maybe I got to get a new one, or redoing the kitchen, whatever it may be. A lot of home improvement projects took over during the pandemic. A little bit more time at home, maybe a little bit more discretionary income saved, as it wasn't necessarily going to recreational activities. So many reasons why there was this tremendous demand pull forward that these companies benefited from, but they did just that. They borrowed demand from the future. And so there's been this sort of whiplash effect where suddenly there wasn't as many home improvement projects, and a lot of these stocks have come back down substantially. But I thought it was really impressive to see that Home Depot, for the most part, is actually higher than where it was by the pandemic by quite a wide margin. And so
Yeah,
it's
Pulte.
weathered a couple storms. It's
I know.
weathered
People
the
say it's
demand,
Pulte.
kind of pull
Pulte.
forward storm.
No,
and
Pulte.
It's also weathered the volatility of last year
Stop
quite
that.
well. I know it's not at its all-time highs, but not every stock is.
And our next name is definitely not. So speaking to some of the trends we saw during the pandemic and that pulled forward growth, I think Wayfair is a perfect example of another name that is just not able to get the love it once got during the pandemic. We're trading at around $69 a share right now. All-time high was $369. So even though this name has been on a nice rally, relatively speaking, over the course of the last month, it's up 3.5% this week. I mean, we are just nowhere near our all-time highs, given some of that pulled forward growth, like you mentioned, Alex. But B of A did actually raise its price target on Wayfair today to a street high of $80 a share from 60, with a buy rating.
SPY broke the low.
Improved industry trends from the first quarter to the second quarter.
Kind of retested there. I grabbed a short on the retest, actually.
A generally more optimistic view on growth.
We had the
now
cup,
into
we had the handle.
2024.
Now we have the
The analyst
breakout.
said that Wayfair's inflection in demand and market share trends appears to have continued through June. And as a
Green to
result,
red
they are
actually on
more
SPY. Wow.
positive now on growth in the second half of this year, as well as EBITDA leverage through 2024. This name does not get the same degree of buy ratings as, say, like a Home Depot. 12 buys, 22 holds, so 3 underperforms and 1 sells. So definitely skewed more neutral overall from the analyst perspective. A name that's still up, 15% this year. It's just very difficult when you zoom out and look at the 3-year weekly chart, because I think that speaks to the astronomical demand they saw, and then they've since given back a lot of that strength.
Yeah, and more so than Home Depot, right? Because what also really benefited Wayfair was they're an e-commerce website. E-commerce saw a ton of demand during the pandemic, as well as there was less in-person shopping in some areas. And of course, the other thing that really is the key distinction here, at least the last time I've been on Wayfair, you're not buying the materials themselves. You're buying the product. You might have to put it together, but you're not buying, wood and screws and nails and things like that. That's more Home Depot's wheelhouse, where they're going to have contractor and professional business as well. You're going to buy a couch, and it's going to come in a bunch of pieces. You're going to figure out how to put it together at home, and it's a blast. It's going to take a whole weekend, but it's eventually going to get done. But that's the kind of, this is a finished product type of a company. And so as a result, how often do you re-up new couches and new bar stools and things like that?
Whole weekend?
So super volatile also as well, given it's a more newer comer to this space. Really interesting chart as it gets to that pretty important level, it appears, as well here on the chart. But what sticks out to me here is this stock was about $110 before the pandemic. It's about $70 now, even given this pretty impressive run as of late. So it goes to show that, again, how impressive Home Depot was to be able to hold on to levels higher than that level, because some of its peers, if you can call Wayfair one of its peers, not so fortunate. But let's talk some AT&T, because this has been a name that I think is so tied to sort of long-term investing, income investing, retirement accounts, kind of old school legacy name. But there's like so little good news when it comes to looking at this chart.
No kidding. So with today's move to the downside, down about 4%, they're pacing for their worst day, or lowest close, since 1994. So 29 years we haven't seen these levels. That is not good. Shares are down 21.5% this year. Also down about 7.5% this week. This was actually the only name I could find throughout our show coverage that is lower for the week. So that's significant here. JP Morgan did downgrade shares to neutral from overweight, with a price target of $17 down from $22, saying that based on recent commentary from management lowering their estimates for wireless and broadband, they believe that AT&T is facing marginally more pressure in mobility and consumer wireline, as well as ongoing pressures to its business wireline. This analyst did note that while AT&T shares are trading at a record low valuation, repeated downward revisions for its key wireless and fiber growth business, as well as high interest rates and some overall uncertainty regarding lead-sheathed cables, will limit this substantial rebound. They do say some potential liability from the copper lead sheathing situation is unquantifiable and is a long-term overhang for the stock. So, I mean, chart looks brutal. You zoom out, there's not even that much to look forward to on a year-to-date basis. The average price target among analysts still is $20 a share, which does imply, I mean, over 40% of upside from current levels here. But I have my own bone pick with AT&T.
Piece of machinery.
I don't find to be particularly great. Today we're seeing, you know, obviously this move to the downside, and it just doesn't feel like there's a lot right now to give any bulls in this name something to look forward to.
Yeah, this is a tough one. Obviously, they made some tough decisions with some of the spinoffs and things that they've done to kind of lean out the company, service some of that debt burden with interest rates going higher. But, you know, from a total return standpoint, so again, dividends aren't guaranteed to be paid, but over the last, you know, 20-some years, when you're citing going back to 1994, they have consistently paid their dividends. So if you've been an investor that whole time, you've collected that various percentage yield over time. But that comes out of the stock, and it's slowly deteriorating this stock down right now until they can stabilize the ship. But all things considered, it's just not that interesting of a conversation. Pretty easy to understand. You know, they sell wireless service. We kind of got it figured out.
I know, and I feel like these telecoms have not been the most exciting names to watch, especially given the degree of outperformance we've seen from so many other names. Just consistently, these names have looked lackluster on a year-to-date basis. So we'll be moving forward today with, I'd say, the two closest comparisons, those being Wayfair as well as Home Depot. We'll be looking at some example trades as well as some key technical levels. Stick around. Next Gen Investing will be right back.
Yeah, that little mini wire thing is pretty cool. A choppy day on SPY, really. Only 115, wow. Still can make a big move today. That's crazy.
once again here, but that remains to be seen if that plays out. So looking at the RSI, we can see that price, even though it's been rising and making new closing.
See if we make an inverted head and shoulders down here now. Head, shoulder, other shoulder over here.
We're actually trending downward on our measure of momentum here, so that's what's called bearish divergence.
Could
Not
be.
really what
Got an
you
engulfing
see
candle down here on
when
the 5
price is
minute
trying
too.
to break out here. We'd want to see price break above that trend line and break above our resistance here. We'd want to see the RSI break above the trend line, excuse me. And looking at our moving averages here, checking in on our yellow 21-day, orange 63-day, purple 252-day, we can see that they're trending upwards. The faster ones are starting to outpace the slower ones.
Masters.
Which is a good sign of trend improving. Maybe not the greatest actual trading signal, but it's worth noting all the same. So we can see as well that price has not really made it beyond this volume node like we talked about here, but the area to watch for some resistance would be this 324 level. That's about where we had our best closes back here. That's kind of where price topped out a few times back before we had this gap down. So we can see as well that if we were to break to the downside, we could see some price find its footing near the yellow 21-day exponential moving average near about 307.60 right now. Then we've got our other two moving averages just below it right there near 303 and 301. But I was also looking at the way the price action is shaping out. I was wondering if we might see a cup and handle type pattern play out where we've got this long kind of circular shape where price formed a base here, and what would play out then would be a move up to this resistance level, a pullback, and then a move beyond that point. So 324 looks like it'll be a crucial point to the upside to watch. It would be really interesting if we saw that pattern play out.
Yeah, 324, like you said, obviously implying some upside from where we're currently trading at around 315. And Truist today with this $348 level, which does imply even further upside. So there it gets believers in the comeback in Home Depot shares. So now in trading this name, considering the fact that we're pretty much unchanged on the year, like Rick highlighted, Alex, this name has just been somewhat disappointing if you followed it along this year and some of the narrative we've seen with home builders that are seeing a really banner year, but not the same for home improvement retailers. But walk us through then what you're thinking for the example trade today, leaning into some of this bullish momentum out of Truist.
Yeah, Scott, at Truist 348 and the buy rating, combine that with that potential bullish setup that Rick showed us with that cup and handle pattern potentially developing. Maybe we are on the verge of a potential breakout. Say you subscribe to that belief and want to benefit from that. I looked at a strategy that would benefit from a pretty substantial up move in this stock. Looking at a 350 call calendar in the name, that it's August, September, giving it a little bit of time for that to actually take place. It is, of course, about $35 above where the current share price is, so over 10% of a rally would be needed on this. But 60 cent was a debit at the time, so $60 in risk, bullish strategy in the risk profile. Will of course illustrate what we're looking for here. Mountaintop-like peak, the apex of that profitability graph, of course, will be at the strikes. In this case, that's 350. So the nice thing about this strategy is it can be customized to better fit an individual investor's outlook for a name. Precision, of course, is the most critical piece to this. The reason I selected 350 is that's basically the price target that the Truist analyst Scott had at 348. But of course, we know that's a longer-term time frame as well. So maybe even if you are bullish, possibly a lower strike price could also meet those goals as well. Those who are bearish, maybe look on the put side as well. So one way to look at this one, Jenny. But most importantly here, risk defined. 60 cent debit means $60 in risk, not accounting for transaction fees.
And now to slightly shift gears and look at Wayfair. Although Wayfair, what really marks it quite differently than Home Depot today is the fact that we're seeing shares make a significant move to the downside on a day when markets are relatively, not necessarily higher, not lower, we're sort of mixed here, but definitely a downward move in Wayfair. And Rick, it's hard to look at the valuation in this name when you look at a 3-year chart, I was saying, because we are nowhere close, but of course it's all relative here. So curious your thoughts on the technicals. I think it's important to readjust our expectations now post-pandemic.
Yeah, the first thing that stands out on this chart to me is the volatility. You know, you can see that we started forming highs near the 74 level, closing highs that is, all the way back here. We dropped all the way down to the 28 level into our yearly lows. Then we went back up again near 74. Then we went back down again, once again. Then we went back up again. Here we are. So kind of a very wide range in this chart here. And it's notable today because we reached our way up to that 74 mark once again and are getting rejected at it. So will this pattern play out one more time? Who knows? But it's very unusual to see such wide, consistent swings in a name like this here. Nevertheless, we can see that we are breaking out to the upside, kind of depending on how you look at it. I thought there was two basic ways to look at this this trend here. One with the trend line starting at the intraday highs going across the high close, or another way to look at it would be horizontal across the 74 level. If you're looking at the downward sloping trend line, we're breaking above it, but we were rejected at 74. Now we're retreating back to that trend line here. So we'll have to wait and see for the close today to see if we can hang on above that level here. We've got this upward sloping trend line as well to keep our eye on, this blue dashed line here taking us from the start of this rally, and we're up very significantly from those lows. I mean, we're up almost 150% from that recent point where we hit down here. So that would be you know, that's an unusual thing in and of itself. Looking at the RSI, kind of an uncertain picture right now. We did see some bearish divergence as well. Price trending upward, RSI trending downward here, making new closing price making new closing highs while RSI is not. RSI also peeked its head into that overbought area, that threshold above 70 that would be a sign of more strength, but it was quickly rejected today. We're heading back below that threshold, which would be a bearish signal actually. So like I said, kind of a mixed picture here. Sign of slowing momentum as price rises here, which is not what you'd want to see, especially when you're getting rejected at a sticky resistance point here. So to look at some support and resistance, let's zoom in a little on our chart here. As I said, the 74 level, that's the point to watch to the upside. That's the point to beat. That's the only way we're going to start making some progress beyond this very broad range that we've been trading in for much of the year here. To the downside, the 21-day exponential moving average is a bit lower here, but it's roughly in confluence with our trend line. So around the level just below 62 would be an interesting place to watch the downside if we break through this trend line once again and start to head lower.
Yeah, and all things considered, I mean, I know we're in a recent uptrend, and I know they've made a nice 3.5% move higher this week. I just think, you know, this name has been somewhat of a disappointment if you followed Wayfair over the last several years. And like you said, it's just been the giveth and the taketh, to channel my inner Ben Lichtenstein. But we will leave it there. Appreciate all of the insight, Rick Ducat, our chart master. So now in trading this name, Alex, walk us through then another bullish example trade, because this analyst we got from B of A has an $80 price target, well above all of the relative levels that Rick just laid out. I know it's 12 months out, but $80 would be pretty optimistic here.
Yeah, with all those technical overhangs as well as an earnings announcement on the horizon, I did a very short-term trade here. Don't know the exact earnings date, Jenny, maybe you could tell me, but I can tell that it's the week of August 4th just based off the implied volatility. So we stayed ahead of that, just going out to July 28th. For our expiration here, looking at buying a call vertical. What we've done is a $5 wide spread for this illustration, the 67.72 to stay below sort of those relative levels that Rick had highlighted around 74. $2.50 is the debit spent. $5 wide spread, one half of that is $2.50. 69.5 break even. So we have that sort of loose guidelines and sort of those check boxes for this type of a strategy. Well, this one hits all of them. Equal risk to reward and break even near the current share price. Right now, Wayfair is trading at $69.55. So right there with the break even, equal risk to reward if done at $2.50. So sort of in our wheelhouse for when we talk about these strategies. If you look at the risk profile, elongated Z, that white arrow points at the break even point, which is very close to the current share price, as we said. And you can see equal risk to reward. But the beauty of this, I think, of this style strategy is that if you're correct in your assessment that the stock would go higher in this case, you're profitable. If you're wrong in your assessment and it goes lower, that is where you lose money. And if neither takes place, you roughly break even. So really gives gives you that opportunity to profit if your projection is correct. And of course, in the other case, if you're wrong, that's where you're going to suffer the pain. But in both cases, define profitability, define risk on this one. So equal risk to reward, $250 to make $250, not accounting for fees.
And they do have their earnings August 3rd, so you were close. Week of August 4th, August 3rd, same difference. It's a Thursday before the market opens. So that is definitely coming up and a catalyst we will be keeping on our radar. But also important to keep in mind for both of our example trades today, they do contain multiple legs that can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk like unanticipated exercise or assignment. Now, coming up next, we will discuss how we're seeing the negotiations heat up here with some actors now joining the writer's strike. Hollywood
At 135, as impressive as this run has been, it's still a long ways away from those levels.
I know, and I think that's really what's so fascinating about so many of these moves here. Like a name like Meta is another one that has made a really impressive move this year, still nowhere near its all-time highs. So goes to show really how much these names had fallen. But definitely positive developments as far as their Prime Day numbers. We did see that sales were 13% higher on a year-over-year basis. Unit growth was also strong, estimated at around 25% now based on preliminary numbers. But the company did further discount, as well as had some more modest additional average selling price pressure. So they are seeing further discounts, which is good news for us as consumers, but then you have to take that into consideration here. Now, some analysts are estimating that this year's Prime Day could represent about 7.5% of their gross merchandise value for this quarter, which would mark a slight uptick year over year. Why I think this is actually so significant is if you look at their AWS growth, it has been slowing pretty substantially, which is why I think we're still nowhere near all-time highs. If you have a major unit of your business that is continuing to lose market share, that's not necessarily what the street wants to see. So the more and more they can continue to crank their e-commerce business, I think is read as a positive here. Citi today mentioned they are incrementally more confident on Amazon's e-commerce business following this relatively positive results from the overall annual Prime Day event. Now, with Amazon's e-commerce business improving overall in efficiency, as well as their web services comps improving, they see now in the second half of this year, and their AI strategy coming into view, they reiterated their buy rating with a $145 price target. Baird also did raise their price target on Amazon to $150 from $130 with an outperform rating, highlighting these e-commerce estimates as a result of these really strong Prime Day volumes. And they are increasing their target now to reflect this slightly higher estimate, as well as updated comparable multiples. So I think this is important. The more and more that they can continue to work on the powerhouse that is all things Amazon.com, I think that the more you could offset some of the potential slowdown in AWS. Now, this analyst obviously out of Citi sees that will continue to improve in the latter half of this year. Obviously, we will wait and see, but Amazon does report July 27th after the closing bell.
Yeah, this is where things can get complex because at some point, it's just law of large numbers. They cannot grow at the same clip as big as Amazon Web Services is growing. It's not like it's shrinking. They're still growing, just growing at a slower pace. So AWS is the story always with Amazon. I still am in the camp that I believe at some point it would make more sense for AWS to be a stock ticker and Amazon, the e-commerce site, to be a ticker, but we're not in that reality right now. And so when you choose to invest in this company, if you so choose to, you're investing in both as little as they have in common as they do. But Jenny, it's really obviously positive to see that Prime Days or the Amazon Prime Day was a successful excursion, because I'm not sure what the macro read-through would have been if it was a big flop.
Yeah, I mean, that would have been, I think that would have signaled weakness then in e-commerce as a whole, right? I think Amazon is oftentimes seen now as the barometer of how consumers are spending, where they're spending. I think that right now it could be a pretty fair assumption consumers are looking for a good deal. So some of these deal days do attract then those that maybe wouldn't be purchasing as frequently as, say, myself on Amazon. But I definitely think this then gives some revived hope that the consumer situation isn't as dire as some of these reports would have you thinking, that consumers aren't necessarily, so strapped for cash that they're still able to spend a healthy amount on Amazon Prime Day. Although I will say credit is a concern. Looking at JP Morgan's report today, we do see credit card figures on the rise, as well as auto loans on the rise. So maybe people are spending money they don't have, but that's a whole nother conversation. But trading this name, I definitely think that FOMO feeling is just the upside. Like you said, nowhere near all-time highs, but still up over 61% this year.
Yeah, and it seems to have accelerated as of late. And so looking at a strategy, Jenny, that acknowledges the performance but still is looking for at least a stabilization, if not further upside, looking at selling a put vertical below the market, but pretty close because, again, we got earnings not too far into the distant future. So selling a put vertical,
okay.
That same July 28th weekly cycle.
Buy on the melt up. I did actually go long here on the inverse head and shoulders in the break of this channel. Market is just pretty choppy today, though.
Here was a $3 wide put vertical below the market, which we sold the 134.
It does seem like it's potentially slowing down, though.
2-to-1 risk-reward ratio, exactly 1/3
it's
the
climb.
Strikes, which is again kind of our
could be setting up a head and shoulders.
Depending on what risk-reward you really want to have.
Shoulder, head.
133 break even is a little bit over $2.50 below
Little
the
shoulder
current
here,
share
shoulder
price.
here,
$200
head.
in risk to make $100, neutral to bullish because it has no upside risk and it does take downside.
We'll see though. We are
risk.
still in this
However,
kind of
if the stock
channel
were
after
just
that
to maintain
handle
its
breakout.
value, this one still could be in the max profitability zone. Looking at the risk profile, it will illustrate just that, which is very comparable to what we looked at in Wayfair, except rather than the current share price being where that white arrow indicates the break even is, we're currently in that max profitability zone, and all else equal, if time were just to pass and these options were at their expiration time, if they were out of the money, the anticipation would be that they would work towards zero and expire potentially worthless, which is the max profitability scenario for this strategy. If it does take a downturn, these options were in the money, did offset through assignment and exercise. You know the exposure going in, that's $200. It's the $3 widespread net of the $1 credit. That's how you get to that 200. And then of course, neither of those figures accounts for any transaction fees that would be associated with the trade.
Right, I think that's really well put. And now to shift gears here, that'll do it for our FOMO segment today, but we'll be looking at Spotify, another outperformer on the year. Actually, some more upside than even we're seeing in Amazon. Shares are up 118% now year to date, up over 10% this week. We'll discuss why analysts are liking this name this week with Renita Young coming up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over.
Happy Friday, Daniel. We got GoEV up 25%. GME down 1.8. BBBYQ up 4.5. And I'm making another cup. Or this is still the handle on this cup. Yeah. Yeah. Day-wise looks like it'll probably be testing here again. Really, that started to form. You can see it starting to make kind of flattening out here. These lows, these candle bodies. And today really kind of for the breakout. But when you kind of need news. Or it's sketchy.
But they lost about $890 million in terms of cost of goods sold. In other words, their gross profit is negative by $190 million. So the company's been struggling financially, but overall the stock seems to be catching a little bit of momentum here based upon this call, as well as the fact that sales growth, like I said, from an estimate standpoint, is expected to double from last year's 27%.
George, it looks as if it's starting to turn the other way from an annual basis, but for the most part, this company's been going the wrong direction when it comes to earnings. It looks like it's getting deeper into negative territory. So the fact that we're seeing sales accelerate, to me, seems like that would be the baseline requirement for investors to be excited in this. So it sounds like they're making some incremental positive steps, but I mean, is profitability even on the table near term, or is that a far distant conversation?
Yeah, so I went and looked. In fact, Alex, if you look at last quarter profitability, or in this case, a loss for 2023, was estimated at a loss of $1.07. Now it's 88 cents. And even for 2024, they're still expected to lose about 33 cents. So, you know, things are improving. That's not, you know, something you have to you have to look at that definitely. And in terms of improving, but if they start to demonstrate positive free cash flow by the end of next year, that might be a signal that things are getting closer from a financial standpoint to break even. So, you know, I do stress that you should expect volatility in this name. There is certainly going to be some additional pressure on the company's balance sheet from the standpoint of them having to issue additional shares because of the fact that they still are not profitable on a cost of goods sold basis. In other words, their gross profits are still negative. So that's going to be a challenge for the business. But if they can reduce costs or actually increase sales, which again, from an estimate standpoint, is significantly improving in the next year, that can change the dynamic quickly. But, you know, price will lead first. And right now, you know, we see volatility today, but if you do consider some of the moving averages I talk about, the 10-period moving average has crossed above the 20-week moving average. These are weekly now, and price is back above those two respective moving averages. So, you know, it's starting to look constructive, but you have to consider the company's still losing money.
Yeah, and George, I was looking at the max time frame. I mean, we haven't been near their all-time high now in better part of the last decades. So
Right.
it's a really interesting chart. We're seeing lower lows here and also lower highs when looking, relatively speaking, at their longer-term price activities. So still a name that has to prove itself and has a long way to go, I think, is the general takeaway here. But we will leave it there. George, appreciate all of your insight today and, of course, all week long on Next Gen Investing. That also does it for Alex and myself for the week. Now, coming up next, we have the watch list with Nicole Pedalides.
I got a nice little rebound. Back up to the WAP. On up through VWAP. This is one of the only squeezy ones that's really rebounded. Oh, Barnes and Noble up again. Cannonball.
For a buck at $75.52 the barrel, while gold is gaining a buck at $19.64 a troy ounce. U.S. dollar remains at more than a one-year low at 99.58, and the VIX right now at a level of 13.39. Bitcoin down 3.7% at 30,745. For some of the biggest stories in the market, we welcome in Caroline Wood, Senior Markets Correspondent here on the TD Ameritrade Network, to talk about earnings. We've been talking about these banks and JP Morgan, and the language from Jamie Dimon seemed very positive.
Yeah, talking very much about a resilient consumer. Taking a look at JP Morgan shares, they're up about 3/4% right now, so off their pre-market highs. It looked like it was going to be a stronger performance from JP Morgan, but just seeing modest gains at this point. Despite this beat on both the top and bottom line, the bank benefited from higher interest rates, better than expected bond trading. These were the first results we saw from JP Morgan since it acquired First Republic Bank, but even without those results, numbers came in strong. Adjusted EPS of $4.37, as you can see, easily topped analyst expectations of $3.62. Revenue rose more than 34% to $41.3 billion. That was well ahead of the $37 billion estimate. Revenue, of course, was fueled by a 44% jump in net interest income to almost $22 billion. Average loans climbed 13%, but deposits did fall 6%. JP Morgan ended the quarter with $3.19 trillion in assets under management, quite a bit higher than the same period a year ago. That number was $2.74 trillion. So, of course, we look at the banks as a barometer for really the strength of the consumer. And in the earnings release, CEO Jamie Dimon said the U.S. economy continues to be resilient, consumer balance sheets remain healthy, and consumers are spending, albeit a little more slowly. And then on the call, they further reiterated that this resilient consumer commentary, resilient U.S. small businesses. Did say in terms of consumer credit, they see it more as a normalization, not a deterioration. Jamie Dimon said the consumer's in good shape. They're spending down their excess cash. That being said, he did say the headwinds are substantial and somewhat unprecedented. So they're still leaving that, cause for concern, a lot of uncertainty out there. But, and they did warn that net interest income is likely to come off these really, impressive levels at some point this year. But otherwise, a really strong report. But, we aren't seeing it reflected too much in JP Morgan shares. As I said, up about 0.4%. This is a stock, though, that obviously doesn't trade like some of these AI plays. The banks are a little bit slower and steadier, already up about 3% this month and about 12% year to date. But
well, I mean, when I look at JP Morgan, I see it 149 and change and think about Jamie Dimon. But when I was talking with Stephen Bigger earlier today over at Argus, he was impressed that both JP Morgan and Wells Fargo raised guidance. That was something that stood out to him. And generally, we had beats from Wells Fargo, JP Morgan, Citi. This really sort of sets the tone for earnings season going forward. So, and of course, JP Morgan with the First Republic acquisition, that certainly helped them with that boost. All right.
We hope it sets the tone. We hope we see more beats and raises, right?
And we have a very busy week next week. That being said, let's check in on the airlines. We had that alliance between JetBlue and American Airlines, and that's been now, sort of breaking apart, right? What are the updates there?
Yeah, as of next Friday, July 21st, customers won't be able to use code sharing bookings on American and JetBlue and vice versa. JetBlue said, "We are disappointed to be ending popular benefits like code sharing and reciprocal loyalty benefits. We know customers will miss these features and believe the U.S. Department of Justice's position opposing them misses the mark." Of course, it was challenged by the Justice Department. And this came after American and JetBlue reached an agreement back in 2020 to partner up in New York and Boston in the Northeast to allow them to share passengers and revenue and to coordinate schedules. That was struck down by a federal judge back in May following the challenge by the Justice Department. They alleged it drives up fares and erodes competition. JetBlue isn't appealing the decision because, of course, they're focused on trying to compete to complete the planned takeover of Spirit Airlines. So that really has to be their focus right now. But JetBlue and American said that they'll work with customers who have booked trips through this code sharing that are past the July 21st kind of ending date. So it's could be some headaches there. Shares of both airlines, JetBlue and American, under pressure today. JetBlue off about 2.7%, American off about 1.7%. I will say, though, if you take a look at all of the reopening trade, we're seeing a lot of red arrows. United, Delta, both down about 3% today. Spirit Airlines off about 1%. So not necessarily sure if it's this news that's weighing on shares or if it's just broader weakness in terms of the airlines.
Yeah, and look, maybe a little
I think it's a little early on GME.
We've had
The long.
run. Thank you so much. Nice update there on that.
See if it bounces off this trend again.
Back to the markets.
It did here. If not, I think we've got room down to this line. That breaks, then we've got room down to 18.
So you talk about the bears have left the building. You wrote that in the note. What does that mean? Tell me more.
Sure. So we think it's fair to say majority of the bears have left the building. You know, when we look at equity positioning and sentiment, it's significant.
That might be a good entry for like a scalp. Like a couple points up to VWAP before end of day.
We think a lot of that has to do with, you know, kind of
Is there a time
a
frame?
attitude on inflation coming down within expectations, but also seeing, you know, this growing recession fatigue coming into the year. A lot of investors thinking that the recession may be in the first half of this year, and that's really been pushed out into next year is consensus. When we look at AAII investor surveys, it's at the highest, most bullish reading since 2021. The put-call ratio on a rolling 10 days at 0.84. That's the most bullish since November of 2021. We've seen a large spike in retail flows, especially in single stocks over the last month. You know, net speculative positioning in S&P futures. We saw a big short covering over in June in terms of people getting net long futures in the S&P. Still net long NASDAQ. We see high beta outperforming, like I mentioned before, rate cut expectations now being pushed out to 2024. And as you mentioned in the intro, you know, the VIX is at 13.5 today. You know, that's all indicative of kind of a risk-on bullish attitude. And the tricky part of the cycle, we think here is, you know, recession odds have been pushed out. They haven't been extinguished. And ironically, going into recessions, you tend to have really strong equity markets. So at this point in the cycle can be kind of tricky, kind of balancing, you know, price behavior, kind of what you're feeling versus what the probabilities may lead to in terms of recession or further slowing of the economy.
So if it's been pushed out, I mean, there even been talk about what the Fed will do next year and the possibility
End of week day trades?
cuts.
I don't know.
That has been pushed up, right? I mean, that was sort of looking like it would be mid-year. Now there are bets that it's going to be happening earlier in 2024. With the Fed likely to still raise rates here, you're not worried that everybody's sort of running in the same
GNS is
direction.
popping there.
The bulls are back to a certain extent. Do we get worried that the trades get crowded?
I don't know. Neg just climbed back to VWAP.
I would. You know, it's kind of one of those contraindicators to say when, you know, everyone's, you know, feeling much more bullish, you know,
Maybe
that's the time
GNS.
to be taking risk off the table. And
I don't know what it's doing.
Really attractive opportunity to dust out the old faithful playbook, right? It's boring. It's not a great soundbite, you know, but it's prudence, you know, as a risk manager to harvest the gains. There's been a lot of concentration in, you know, high quality mega cap tech. And we've seen a lot of bidding up within those specific sectors. It's a great time to readjust, harvest some of those gains, and move them into some of the laggards to kind of pair that up with staples and healthcare.
Beyond might get a move up to VWAP.
But certainly at this point, you know, with the rate of change in terms of bearish.
Yeah, probably Beyond for a little scalp.
It tends to be more
That's the only thing I see right now.
than to say, you know, then we would sit here and say we're going to extrapolate and add risk at this time.
Let's talk about what you do like here in a balanced portfolio. Someone's rebalancing. You said mid caps, small caps are probably a good place to be. Tell me about that.
Yeah, when we look at valuations for small and mid caps, you know, from an absolute level relative to their history and also relative to kind of the mega cap cohort that we've seen. Kind of
Yeah, neg to the high of the day, but there's not much risk for reward there. Your stop would be down past VWAP. You're pretty close to that
12-month forward returns
high of the day.
very strong. And so we think that's a good opportunity. And most clients in general are underweight small and mid caps. And so we think that's a prime opportunity to take
buy daily calls.
Another area we
Can't go wrong with those.
a lot of momentum. We clearly see the money market flows and the assets that money market flows and money market funds
Especially on a Friday.
have gathered year to date. But we're quick to remind clients to say, giving up short-term bonds to move into money markets is great. You remove the price volatility and interest rate sensitivity because you eliminate your duration. But as the Fed starts to pause interest rates and economic activity slows, if there's any cuts in the near future, short-term bonds give you a much
All right, Jay from the Bay.
total return.
Have a good weekend to you too, bud.
And
Thanks
you
for the
lose
support.
that, right, by moving into money markets. So
Thanks for your thumbs
I
up.
think utilizing and leveraging
Got 30 of them well done, guys.
duration bonds, again, not sexy, but
GME 0 dates? Yeah, GME options don't really move much, though.
The money's flowing within money market funds.
More.
You said maybe stay away from industrials. That was something you said you don't necessarily like right now. And financials?
Right. Yeah, when we look at
Yeah, if Bed Bath & Beyond doesn't work, just go with Beyond.
Domestically, and it's even more pronounced
Right.
Overseas in Europe. But there's usually a tight correlation between the rate of change in manufacturing and when cyclicals, industrials, financials outperform over defensives. And we've seen that break down dramatically, where we see industrials.
I was more talking about shares than options.
Highly outperforming defensives, even
But
though
I suppose the daily options would work too.
Continue to decelerate domestically. And
Know what it is.
Now seeing that really start to slow down.
Needs to be liquid. Needs to be.
Even though the sector leadership hasn't caught up.
Mover.
So we think that is nothing's easy in this industry. But from a risk-reward standpoint and the price leadership we've seen of industrials and financials relative to defensives, we think that's a good risk-adjusted move, is to underweight financials and industrials at this point and overweight staples and healthcare.
Alexander Reed, great to see you. Thank you, of Envisage Wealth. Thank you. Okay, later this hour, the CEO and founder of Musk is joining us. So, talking all about a new ETF that offers pure play exposure to the global music industry. He'll join us here at the New York Stock Exchange. Also, we'll break down new insights on how AI can transform
shares.
with Zeta Global's chief
This is the way.
technology officer. And our panel ready to talk about that consumer sentiment print and what's behind at least the parts of it that are upbeat. Okay, and up next, let's take a look at a name like Amazon. We have
Barbecue bounced up to VWAP there, 3190,
next.
up 6.3. There's GME's move up to VWAP. See if SPY can kind of break out here. Breaking out of this channel. Back in the barbecue, 2940. Nice. Well, today might be the last day. Cameron says it's due by end of day, so I think by Monday you should know whether those shares have any value.
potential obesity treatment to its holdings. The big pharma company plans to buy Versanis in a cash deal that could be worth $1.9 billion if certain conditions are met. The company has a candidate in late-stage trial that aims to reduce fat and overweight and obese results. So we're continuing to follow that story. And shares of Eli Lilly are up over 22% on the year. NVIDIA, all-time high again, after Truist raised the price target to $545, up from $470. A note to investors reiterated Truist's buy rating on the stock, while raising end-market revenue growth expectations for NVIDIA's data centers. NVIDIA's shares are up more than 320% from their yearly intraday low. Leslie's shares are falling after analysts, including William Blair and also Piper Sandler, downgrading this stock.
Should probably have a stop on your beyond position.
Fiscal 2023 outlook. William Blair lowered Leslie's to market perform from outperform. Piper Sandler downgraded it to neutral from overweight. And AT&T on track to close at its lowest levels since September of 1997. That's after JP Morgan became the latest to downgrade the telecom company to neutral from an overweight.
Is the rebalancing going on today?
Cited pressure consumers and business wireline. It also pointed to the potential liability for the ongoing copper lead sheathing situation as a long-term overhang on this stock. How about Bitcoin? Check it out. It did get above 31,000 yesterday after all that Ripple news. Now it's back to 30,835. Let's welcome in our next guest. Andrew Ahrens is with us, founder and partner of Synergy Advisory Management Group. Thank you for being with us. So we got in a lot of news this week. So tell me more about it, Andrew. What are you thinking after we got into those economic prints, and we'll get to earnings as well.
I think it is. It might be today.
Well, I think what we're seeing here, obviously, the consumer is still spending, right? I think that's we have a resilient consumer, and it's really keeping the economy doing very, very well. And the market's been
I'd probably stop out of
doing
that.
Extremely well.
That beyond.
Year, I had anticipated that, and now that everyone seems to be very, very bullish on the market, is a time where I still think the market's going to do pretty well, but I would be cautious here, and with some of the sectors. I still think that there are a lot of stocks that are undervalued, and I'm going to talk about a few of them today. That have gotten
beyond
hurt during the pandemic.
I mean, you could hold it. I would probably close though if you make a new low here.
We have a ways to run here.
All right. So that being said, as we take a look at the names, I just wanted to talk about Amazon because we just had the Prime Day, where in fact it had a record as far as sales. The growth was 6% rather than the 10% that they were hoping for, but still. What is it about Amazon that jumps out at you these days? Because I know that you had been bullish on stocks overall, and you've done some great picks and called this market, which has been moving higher. I mean, when I look at the NASDAQ up 40% and the S&P up 17% this year, it's been an incredible year so far.
Right. I mean, I remember in January, people were kind of laughing at me that I was actually very bullish on the market. And, I was, and I see that, a lot of the fundamentals, the market is generally trading, 6 months ahead of itself. So,
a new low there.
In advance, so we can kind of see what's going on here.
Eyes dropping too.
Amazon, really got hurt when interest rates were going up, and that was a big problem. Was cutting into, their profits, and right now we're seeing inflation, getting under control here, and the consumer is just still spending. They had one of their better Prime days.
Flush on SPY.
$12.7 billion in sales, which was really good. And I think that when you think about it, that's almost more than some of these big box stores do in a full year. So I think this stock is still trading at attractive levels. I don't think the current valuation is reflective of the full potential of the stock. I mean, the stock is still trading 30% lower than it was trading, at its all-time high. And, it's embracing AI here, which I think could be favorable for the stock in the future. And I think if we avoid a recession, I know some people are kind of pushing it out into next year. But if we do avoid a major recession, which I think we will do, I think this stock could be a very big beneficiary and could make all-time highs, possibly next year.
Oh, wow. So we'll continue to watch this one. I mean, it went from $81 up to where it is now, about $135. It's had a great run. Just even over the last 3 months, it's up 32% for Amazon. So a good run there indeed. How about Carnival Cruise Lines? That's one that you also are highlighting today. You like this?
Yes, I do. I think it's up. We see these stocks that are up over 100%, but they got really walloped, down during the pandemic. And obviously, Carnival Cruise Lines got hit very hard and saddled with a lot of debt. But people are coming out right now, and they're traveling more than ever. And Carnival was able to raise their prices, and still people are still coming out. And the summer is really the best season for travel, and we're seeing that. And I think that we're going to see the stock continue to do very well, at least towards the end of the year.
Right, understood. I mean, how do you think earnings so far are going? You liked tech so far. I wanted to know if you're backing out of tech. We just got in some of the financials today.
Yeah.
What are you thinking?
I still think I'm not backing out of tech. I think there's still a little bit of room here. Obviously, the easy money was made in the tech market. I would say that we're getting into like the maybe 7th or 8th inning of this run with tech right now, and then we'll see something, another sector kind of pop up where all the money will start to move into. And my opinion may be that early next year we start to see the money flow into the financials at that point. But right now, I think tech will do well, probably towards the end of the year. And I'm not expecting anything with rates right now. Possibly we'll see rate cuts early next year, and hopefully that will help the real estate market.
Andrew Ahrens, great to see you. Thank you so much. Synergy Advisory Management Group. Thank you, Andrew. Coming up, a new ETF is offering investors pure play exposure to the music industry. So the founder and CEO of Musk, I'm calling it Musk, it's music. Okay, let's talk more about this. The watch list continues.
show like net assets of a certain amount of money. This is really designed for the self-directed investor who wants to invest any amount of money in music. Music, I just read the Goldman Sachs report. Music's doubling in revenue to $131 billion by 2030. I just read the new Luminate report, 4 trillion streams of music in the first half of 2023. So streaming is driving a lot of this market, streaming and content. If you look at the 48 companies on our index, 40% of those companies are streaming companies. So big companies, Apple, Amazon, Google, are all big important companies, but we also cover smaller companies, Stingray, Click Digital, Cloud Music, Live One. These are all streaming companies that are all...
I didn't realize they were all publicly traded.
There are 11 streaming companies are on our index. The second big category is content. 33% of the index is content companies, about 20 on there. So there you have big companies like Universal and Warner Music Group, but you also have tons of K-pop companies there too. Hive, SM Entertainment, JYP, YG Entertainment, YG Plus, Avex in Japan. And then you have the smaller royalty trusts, Reservoir Music, Hypnosis Music, Roundhill Music. So our fund gives exposure to small cap, mid cap, and large cap companies.
Oh man, this is so cool because this is right in your life, in your wheelhouse, and it's something you're passionate about. How do you go about making money with this fund? I mean, did you bring in a team of folks that are great at investing in this kind of stuff? I mean, because if you're transforming from being in the music industry, you know, how does it transform into running an ETF?
Well, I've been investing in music for a long time. And these stocks, I mean, they perform very well. If you look at the index, it's up 21% for the year. So they're actually outperforming the S&P. They've done extremely well. As an investor, this index is really designed for any investor who wants exposure to music. You want these are stocks, these are equities. This is a very balanced portfolio of equities, and this, as I said, this is really designed for a self-directed Robinhood investor all the way up to a pension fund or an endowment. And it's something, you know, investors shouldn't have to pick one company or another. They shouldn't have to pick, I want to put money in Universal, I want to put money in Warner Music Group, or you invest in the index, right? And this gives you access that if there's a tour that's exciting, you see the results from like the Elton John Yellow Brick Road tour or Taylor Swift's tour, you know, look at the Live Nation stock. If streaming is up, you're going to benefit from all the streaming stocks. So this way, this is a balanced approach for an investor to get access and exposure to music as an asset class. That's what it's designed to do.
It's amazing, and there's a lot of big names. You mentioned a lot of these already. Universal Music, Warner Music, Live Nation, Spotify, Sony, names people know. You also mentioned Taylor Swift, which brings me to what goes on with these concerts and things. I mean, there's so much demand. She had the battle with it. Was it Spotify?
The battle first was with Live Nation.
And the tickets, right? I mean, it's just, how do people grow in the music industry now? I mean, because you have people who just put out one YouTube video and then they're a sensation. I mean, I feel like that's one in a million.
Well, look, you're addressing a lot of issues right now. So AI is a real big issue in the music industry.
Yes.
You have 120,000 new songs being uploaded a day as a result of AI. Artists that aren't even artists, they could be robots. You saw like the fake Weeknd and the fake Drake. But here's what's important is that labels are becoming so much more important because of that, because you still need a curator. You still need a group of individuals who can actually curate taste for consumers. So there's a lot of music, there's a lot of demand. Look, touring, it shows you like audiences want exciting, great tours. And Taylor Swift is a huge force. And she has a right to be upset, by the way, because like there are bots that are buying all these tickets for $50 and they're trading them for like $10,000. And so, and the same thing with Springsteen. If you're a Bruce fan and I'm a Bruce fan, like you want to buy tickets for like $150 or $200, not $2,000. And so, you know, there is an issue out there with bots arbitraging a lot of the tickets.
Oh, I could talk to you all day because this stuff is so exciting.
But here's what's exciting about that is that we benefit from all that because we cover ticketing, we cover live music, we cover content, streaming.
And you have all that in the
And we have all these are on the index. So it's all about, you know, if one is outperforming another, you know, the investor is getting exposure to everything. in the example like the ticketing, if the artists are getting a little bit less, there's a ticketing company who's getting some more, and so those are companies like Vivid Seats, company like CTS Eventum and Live Nation. All these companies are on our index. We are giving exposure to every single aspect of the global music industry ecosystem for an investor who loves music. If you love music, then you invest in music, MUSQ.
I mean, it really is. I'll tell you, and you also, I use my kids as a barometer. Okay, I mean, they have picked Nike and Chipotle, and they knew when Adidas was getting better than Nike, and then Nike came back. They are music. They wait for everything to drop. Everything is streaming. Obsessed, totally obsessed.
And
so
they're learning that. They're learning that on TikTok. They're learning that on streaming services.
Right.
I've got a 13-year-old daughter. She's obsessed with music. I'm discovering music from her on TikTok. These streaming services are really valuable, and kids are really driving a lot of the support in the industry today.
But as you said, AI, that's problematic, right? That's very problematic. The final thought here, do you have other ETFs that you are associated with, or is this your one and done shining star?
Well, I don't know if it's done, but it's certainly my first one, and I don't think it'll be the last one. But right now, I want to make this really big. There's $10 trillion in ETFs. I have to believe some of that money is interested in music.
Do you have famous songwriters or singers that are also helping to promote this with you?
So I'm talking to some artists right now.
That would be cool.
Yeah,
then
well, I have to say,
people would learn about
Sam
it.
Smith wanted to come to the floor yesterday to ring the bell. And so I talked to his two managers. He's on tour right now. Sam really wanted to come. And I'm talking to a lot of other artists right now.
Come back and bring Sam with you.
Well, Sam, if you want to come back, everyone wants you here, Sam. We were just together 2 months ago, and he's a fan. He always wanted to come ring the bell. But look, part of what we want to do is also give money to artist charities, Nicole. We want to support the industry with this. We want to make this the triple Qs of music. We want to make this big for everybody. If you love music, you invest in this platform, and the platform should give money. It should give money to charity. It should support artist charities. This is a platform that should feed on itself.
And so, I didn't mean to interrupt you there, but as you said, knowing the music industry, but it has so many different parts of it. I mean, I saw even like satellites are in there. I mean, just all kinds of things that help music get from the starting point to the ending point. Are you worried about any sort of strikes and things in the music industry, the way what we're seeing with the writers and the Screen Actors Guild? Is there anything that would be sort of similar in the music industry that could affect these kinds of companies? Because there's already worries about some of the streamers for the shows.
Yeah, no, it's a good question. So look, there are two bodies that protect the artists and that protect the writers.
GNS,
the RIAA
still kind of climbing up there.
The artists, and the NMPA, the National Music Publishers Association, represents the writers. And so every 5 years, they actually renegotiate rates. And right now, it's time to renegotiate some rates for the artists. But again,
Flying back to the low of the day.
Go up, that just means more money into the content companies, and those companies are on our index. So if there's never an imbalance as an investor, because you're hedged. You are hedged. Yes.
Understood. It's great to speak with you about this.
Thank you, Nicole.
Congratulations. Something really different on Wall Street. I've been on Wall Street for 25 years and never heard anything like this. So thank you for bringing this to us. David Schulhoff, founder and CEO of Music, the ETF, MUSQ. Still ahead in the second half of our show, Zeta Global's Chief Technology Officer joins me to break down some new insights on how AI can transform marketing. And we'll have to break and take a look at winners and losers in the S&P 500.
Buy at the low of the day. Not a new high on barbecue. 31.99. It's up 6.6. Right above VWAP. About an hour and a half left still. 32 cents on it. Had a little volume that last one. See if we get a move on barbecue starting here. There you go. 32.12. It's up 7%. Ah, tough build, 6.6. Close this out this morning. Full flag looks nice. High of the day is 33 cents. Barbecue's at 32 cents. Happy birthday, Liechtenstein.
Yeah, we head into the end of the week much like we have been all week with the focus on the US dollar and some of the weakness we've been seeing there with strength in the stocks and the move lower we've seen in rates. Taking a look at the dollar sign DXY, so the dollar index, you can see we got down below 100 this week and no rejection of that lower level, mostly just sideways. Here's a look at the bigger picture. You can see how we've broken out of a range lower, a range that we've been in since January. A couple quick products to keep an eye on next week because this is what's pushing the dollar lower. You've got the euro currency to the upside, and here you can see even the yen has been strong. A bit of a divergence here though between rates, right? They were up near the March highs. The dollar got back up to, well, around this 101, 102 handle, but here you can see as rates have started to come off, the dollar has. I'm just wondering, does this mean rates are going to inch their way back down? We see the TNX near 3%, 3.2%. Let's keep an eye on it. If we get back down below 3.6, 3.7, it opens up a door for a retest of that lower extreme we've been in, the range we've been in since October of last year, Nicole.
All right. Thank you for all of that. Really appreciate it. Ben Liechtenstein, a busy week we had. And next week, we'll have a slew of earnings. So get ready. Thank you so much.
Did she not wish him happy birthday?
Right now, Christian Monberg's with us, Chief Technology Officer and
So
Head
rude.
of Product at Zeta
Cole.
Global. Thank you for being with us. So we've been talking about this and teasing all day about AI. And this is a different way, not the same way people are thinking. Tell me a little bit about where AI falls into your wheelhouse and what you're focusing on.
That's a big question. Thanks for having me, Nicole. So AI is an area that I've been deeply invested in for about the last 10 years. And at Zeta Global, we've been reimagining where AI is going for a
Peloton
while.
down
Building on the
9.
underpinnings of our platform,
Niner.
market platform. We've been trying to
Top
simplify
handle
the
might be
marketing for our
forming
customers.
here.
We do that with a great data and identity asset, but where we shine is in intelligence. We're able to help our customers, brands, understand their business through a new lens using generative AI and other AI capabilities in ways they've just never thought of before. And that's where we get a big leg up in the business. After that, taking that intelligence and activating it is our primary goal for our customers. But so much has changed. I think the big opportunity for businesses right now is to take everything they've learned and start pivoting towards the new tools that are available.
Yeah, I mean, you talk about using AI for marketing. And so what kind of industries can really benefit from this?
Well, in the near term, we're seeing a proliferation of tools in the marketing space. There are bigger gains to be had. I think we're just at the infancy of this AI revolution. Where I'm most excited to see changes in AI happening are in places like healthcare, even the sciences. I expect global warming will be massively helped through findings in science. I expect people to live longer and live healthier than they have before. Even in supply chain management, we'll see AI have big, dramatic impacts. But some of these are still over the horizon. We've got brilliant minds in academia and in institutions alike that are working on the problems. But I'm seeing these gains in enterprises already. Our customers are still trying to figure it out, and we're helping them figure it out. And everything from how they communicate with their customers in real time in a more predictive and frankly empathetic way to getting more performant outcomes from the campaigns that they're operating.
So tell me about the agents powered by Zoe. Because I can hear all your different things about AI. It's sort of, and understandably, it's a little bit all over the place, and that is because of the way AI is developing. And you said, look, it's used for marketing, it's used, we're helping our clients sort of stay with it because there is so much going on. So I'd like to be a little more specific so we have some takeaways from this about where the AI fits into your business and explaining it to folks. I know you were talking about the study as well. Give me some more specifics on this. Something I could
Sure.
deep into.
Yeah. So starting high level, we commissioned a study, and we found that over 50% of marketing leaders, their technology is failing them and their data is not integrated. Somewhere around 40% of those have over 15 technologies they're integrating together. Why that matters to AI is amazing, but it really is dependent on data. So having an integrated strategy is critical. The more AI proliferates, the more critical that integration strategy will be. Where it's helpful is in understanding customers better. I'll give you a simple example. Personas. Personas is an exercise in understanding customer archetypes. And for years, it's been done manually, and people hope it's right. Oftentimes, you're working with a third-party agency or strategic consulting firm to put together those personas. Working with Zeta, the AI just looks at your data. You don't have to do anything besides provide it real-world evidence of how people are interacting with your brand, and it will create those personas for you. So now you have real handles of groups of individuals that are even named through generative AI with different attributes and understandings of what they're interested in. That gives marketers handles, levers they can pull on to create new curriculums and programs to engage with their customers.
Yeah, understood. What are some of the questions that the clients ask? Because, you know, this is something that is going to be developing on a regular basis, right? And there are a lot of risks when it comes to AI. What are some of the most commonly asked questions?
Well, there is a little bit of moral panic around AI and understanding what it means if their information or their data is interacting with these models. So that's one of the first questions that we come up with against, and we work with our customers to understand how their models are cordoned off.
10 minutes to power hour.
Privacy, governance, security are all top of mind for our business. Next question they get into is, great, AI can automate the world away, but I still have a role. And in truth, the marketer and their intuition is critical to building a brand. And so rather than thinking about a world where AI takes over all the marketers' jobs, we're trying to assist them in their jobs to make it easier. The hope there is that instead of creating imagery to go in all of their campaigns, from email to display media like ads, that we put those campaigns in an editor and we say, hey, marketer, go look at this stuff now, put on your final touches, approve it, disapprove it, try again, and then move forward with a bunch of assistants, a bunch of bots that are going to move faster for you and automate parts of the job that aren't as meaningful. When done correctly, we're bringing more humanity back into this business. And I think that's where brands, in some ways, have lost an opportunity. They've been so mired in the data, day in and day out. They've lost that finer control of intuition and really empathy, understanding their consumers and bringing a creative mind to it.
Christian Monberg, thank you so much. Great to chat with you of Zeta Global. Thank you, Christian.
Thank you, Nicole.
Still ahead, our panel is ready to discuss today's consumer sentiment data, which came in better than expected. But within that data, there's also expectations for higher inflation going forward. So I want to get some of the key takeaways, what it suggests about what happens ahead. Our panel is ready.
Well, pretty mellow Friday. Unless I actually didn't figure out if that ETF rebalancing is happening today. That could make the last bit quite volatile. Barbecue came down a little bit. Back to VWAP. Little sell off on barbecue there. 31.29.
And concert and sporting event demand, all this pent up demand.
Here's the bottom of that range of barcode.
Continues to roll as the pandemic has been put in the rearview mirror. So I think that's a really positive sign. I mean, yes, there are some people struggling. There are people putting necessities on credit and financing that at very expensive interest rates. And yes, delinquencies have gone up a bit and banks are adding to their reserves. But I didn't think there was anything out of the ordinary in the earnings reports today about that. I thought we were actually bracing for even worse in terms of maybe a larger rise in delinquencies or larger reserves. I think what we got was very much in line with expectations, maybe even a little bit below that. And I think, normalization continues to be a theme, back to 2019 kind of levels, but nothing more dramatic.
Right. Ben, you were also looking at the economy and how important the consumer spending part of it is. Obviously 2/3 of GDP, and so far so good, a very resilient consumer. But what do you think happens going forward? Because you talked about households and that, the income gains remain buoyant. Are we going to see a slowdown in the economy? Maybe wages come down. Maybe there's more unemployment. Are you worried about that?
I think in the near term, all these positive momentum is going to carry through to the third quarter. So, maybe coming into the year, we thought that there might be a recession starting by midpoint of 2023. Certainly that's been put off and delayed. And I think the soonest you're talking about recessionary conditions is the fourth quarter, and it might even be later than that. We are on this gradual slowdown path for both the labor market and consumer spending. And eventually, I think those are both going to turn negative. But certainly the runway continues to be extended. And at this point, yet again, I think we're still going to see a recession. I don't think we've completely canceled the recession, but we certainly delayed it and looking at the earliest at the end of this year.
Right. Understood. And so if the recession's delayed, that's something, I wonder, if we'll get the soft landing and maybe it won't be so bad. Ted, what are you waiting on as far as prints and things going forward? We are getting the Fed at the end of this month.
Yeah, it seems like a quarter-point hike is pretty much locked in for this month, but that may be the last one. We'll see. I know the Fed's going to be keeping a close eye on future inflation data and jobs data, but it's been really positive lately. The CPI recently, PPI coming in quite low. So I think there's really a lot of positive signs here. All that said, we recently surveyed about 24 leading economists, and they still put the odds of a recession within the next year at about 6 in 10. That's down slightly from last quarter, but there is still this expectation that a recession is coming. I don't know. I think the soft landing hypothesis is gaining some steam, and I think that the recent trend has been quite positive, and I think people are noticing a higher stock market. I think they're noticing lower inflation. I think there's been some real progress here.
Also, we see the real divergence between some folks really having a hard time, right? In the lower income bracket, they've really felt the high costs. Tell me a little bit about that, Ben.
I agree with what you're saying there, that, the rising prices, especially for staple items, hit the lower income brackets much more than the higher income brackets. And, what we're seeing right now is, as Ted mentioned earlier, there is some increase in leverage, an increase in using credit cards. And that's certainly on the lower end, that's probably paying for everyday purchases. But the middle incomes, the higher incomes doing quite well. And that's where you're seeing a lot of the still interest in buying a car, buying a home. Even with the higher interest rates, they're saying we can still afford that. And there's a lot of positive momentum still within the middle and the high income bracket. Going forward, I'm a little concerned, obviously, especially for the lower incomes, as we potentially enter a recession, typically that's the area where you see more of the job losses than on the middle, the higher income. But at least for right now, everyone's still doing quite well.
Thank you both. I feel it all the time with everything I'm doing, whether it's renting a car or buying something. It's still very prevalent, and I guess it's just the new normal. We're getting somewhat accustomed and entrenched inflation. That's what the Fed doesn't want. Thank you both, Ben Ayers, Ted Rossman. Thank you. That's going to do it for us here on the Watch List. Thanks for being with me. I'm Nicole Petalides. Have a beautiful, safe weekend, but you got to keep it right here because Market on Close with Oliver Rennick is next.
Power hour, 1 minute. Any low of the day there. Just respecting this line here. Alright, it's more like that. It did have that one breakout of it, which kind of threw me off earlier. This one. Well, I went long there. But just a little false breakout up to VWAP. Low of the day. Definitely some profit taking. Into Friday close. Rip you copy. I'm concerned for PP and all the crew. This doesn't work out. There's gonna be people that want his head. Yeah. No, I know. Yeah, he's got like 500,000. I'm not as much concerned about the money they're going to lose if it doesn't work out, but more the people that are going to want their head. If there's no scenario where you would change your mind, then you're way too married. And it's something I want to ask him in private because I want to put him on the spot, but something I'm not asked PB. But I don't think there would be. They say they are, and then when they actually get to zero, different story. No, that's what I'm saying, yeah. I mean, he had a filing saying he sold all of his shares. And that didn't matter. You know, back in August. Just like a normal Chapter 11 case didn't seem bad. I I don't know how it doesn't seem bad. Before they canceled the auction, before the IP of both Bed Bath and Bye Bye Baby were sold, I would agree with you.
About some of the stock moves, but I do want to first just kind of go back to that print this morning on sentiment. Kevin, is that what spoiled the party here into the weekend?
Well, if you look at the 1-minute charts, Oliver, it certainly says that, right? Yields went from lower to higher. The dollar went from lower to higher. So that, I think, shook. I mean, that was part of it. I believe that the underperformance from banks on pretty good numbers was part of it. Why? I think it throws a cautionary tale into earnings coming up. Why? Because next week we'll get more financials, more airlines, Netflix and Tesla next week. And maybe the look is on stocks that have run a long way.
What scenarios would bondholders be screwed in this and not shareholders?
You know, even JP Morgan, that's hanging on to gains for the day, was significantly higher than it is right now this morning. So maybe a little bit of a cautionary tale, both macroeconomic and earnings-wise, shaking this market a little bit in the end of the day, Oliver. Just a cautionary tale. People holding stocks with earnings coming up on the horizon, maybe looking at the good earnings out of financials and the lack of any more upward movement, saying, uh-oh.
So you think that the fact that banks couldn't carry the market, we talked about that this morning, right? I mean, this was a test because the NASDAQ started off a little sluggish. Banks had the opportunity when the Dow was higher to offer some leadership in the absence of a big tech rally. We didn't get it. So it was, I guess, arguably kind of a failure on that front.
Yeah, I mean, you know, things, we talked about this yesterday on Fast Market and today. And when stocks are at highs and there's no real reason for them to sell off, there's no impetus. We said they have room here to run unless when they're up at these levels, they're the most fragile, Oliver, and a feather can shake them. Now it looks like bank earnings all good across the board. JP Morgan clearly showing themselves as the gold.
In both those scenarios, though, bondholders get something.
Not a lot of follow through on some of
Or
these stocks.
shareholders may or may not. And if they do, it's probably not better than bondholders, right?
You know, it's the argument, Oliver, that we've been going through all week. Stocks have written incredibly historic run the first half of the year, but some of them are still significantly off their all-time highs. And where do you go from here, Oliver?
All right. It is Friday, though, Renita, and it was still an up week, so let's throw something positive in here.
Yeah, why not?
Fitting with kind of the switch-up of leadership today and the surprise fade in markets, the big winner was actually a big loser on the year coming into today. That's United Health.
You're right, because that stock is lower than most on the year.
Yeah, it's been
today,
rough.
Yeah, today it's rising about 7%, and it's because it got better than expected earnings. Now, the biggest concern heading into this report was the rise in elective surgeries, and it was raised the costs of doing business for United Health. But the company still managed to bring in adjusted earnings at
So why are the bonds trading basically at zero? Why wouldn't you just be buying those?
Grew pretty substantially, almost 16%.
Why wouldn't there be demand for that?
$92.9 billion. The revenue from its other platform, Optum, increased nearly 25% to $56.6 billion alone. Now, those medical costs, make no mistake, they did grow. They increased to $60.27 billion. And then earnings from operations also grew to $8.06 billion with an operating cost ratio at about 14.9 billion. Now, if we break down the different sectors, United Healthcare served about 52.8 million people. That was just below the 2022 numbers, but there were more Optum Health consumers. They served 103 million year over year, around that number. Now, the medical care ratio is the percentage of payout on claims compared to premiums. That grew to just over 83%, or grew 83% more. And the company did raise the low end of its full year outlook as well. Adjusted earnings is between $24.70 and $25. That was up from the previous expectation of $24.50 up to $25.
That's a big one because we weren't sure how they were going to be able to predict the future with changes to Medicare costs. Bottom line, there's a lot of growth in those numbers for a company that does huge numbers already. So you're moving a big ship here with every percent change on a $90 billion a quarter revenue stock. And the elective surgeries, we also expected that to happen as we were getting hospitals more active and more normal post-COVID, but it wasn't certain how it was going to play out against the cost. So even though the cost went up, they're paying people out for insurance, still generally overall revenue here was enough to offset that.
It was, and so I think people actually underestimate the effect of that, because there had been a huge glut of these elective surgeries. People are backed up for months, some even going into 2024 for different appointments for elective surgeries now. And so that being able to get cleared up, or at least a pass through, I should say, that was a big deal.
All right. Well, it's a big winner on the day and a down day, so I guess it finally rallied when it counted. United Health up 7%. Thanks for the earnings help this week, team. Renita and Kevin, we're just getting warmed up. Next week, going to be busy with reports. But let's stay with the big picture topics and let's discuss the macro outlook with Chris Recker from AZA Capital Management. He's the Chief Investment Officer.
I see.
He was bearish at the right times leading up to
so the bonds are
biggest weak spots over
decreasing in value per se.
We still don't seem like we've had that big
as time goes on. Makes sense.
Chris, more just like our valuation blow off last year. And now folks seem like that major economic risk isn't
to new buyers.
I think it's good to note that in these types of markets that, back in 2000 to 2002, there were maybe a dozen 20% plus rallies. And, we're still not at the all-time highs yet. And we're looking at a lot of indicators that still are telling us that we're going to have tough times ahead. So that's inverted yield curves, retail same-store sales that are, down year over year. This PPI number is somewhat deflationary. So these numbers that we're seeing come out, we kind of view it as a potentially sliding into recession.
So sliding into recession, but at what pace? Tough times ahead. Unfortunately, we can probably all say that about our lives. You never know when, but something's going to happen, right? I mean, same with the market, right? And it seems like expectations were something bad was supposed to happen by now. All we got were a couple regional banks out on the West Coast tied to some speculative VCs that blew up.
Fair point. And I think that what you'd like to see is, look, we see a lot of things happening in markets. The one good thing that we see is that we're getting real yields in the bond market. So there are alternatives. Like we never say get completely out of stocks, but let's say you held a hypothetical portfolio of 80% short-term treasuries earning 5% this year, and then a 20% stock portfolio, and that stock portfolio is up 20%. That's going to get you close to a double-digit return, and it's with very little volatility relative to markets. So there are portfolios out there for investors that they can construct that can navigate periods like this where we have elevated valuations, recession risks, and so we're pretty sanguine. We're actually pretty optimistic on a lot of things. We are looking at these valuations with not the opposite of rose-colored eye shades.
Okay. A few of the charts that you sent over I want to look at center around those yield curves. The number of different yield curves in the bond market that are inverted. It's one of my favorite charts. Our own Jeff Kleintop has looked at quite a bit. Obviously, the general inversion of these curves historically are attached to recession. I'm hearing a lot of talk from people, though, that these have been now disproven. What do you say to them?
Well, we still have to wait and see. When the 2s, 10s inverts, it's on average, it's about 14 months to recession. That inversion began last July. We're 12 months in.
We're getting close, right?
So we're in the window, and sometimes it can happen 9 months after, sometimes 19 or 20 months. So we're still, I think these curves have some value. Maybe this time we could say that they're pricing in event risk, systemic event risk, as opposed to recession. We're still leaning toward recession. When we look at the data, we're seeing weakness, lower highs in payroll growth, lower lows. So it's a lot of these trends that we see, recessions don't all happen at once. They start slowly and then they gain momentum. It's kind of a snowball effect. And so when they're this inverted, though, we would point out the last time we've seen this many curves inverted and at this level, have been before decent recessions, and so, or serious market issues, back in 2000, 99, 2000, and then 2006, 2007. So we just say it's time to be have caution. Don't go in, full. It's not a time to load the boat. It's time to take advantage of what the market offers and where returns are, and there are still opportunities out there, but it's not like it was in 2002.
Okay. Chris, the nature of the recession or kind of what causes it, that's where I feel like the Fed comes into this, because last year we had very much a Fed-driven sell-off in markets. Stock market, was moving inverse to rates. It wasn't hard to figure out. But now that Powell has shown that he'll take a pause when inflation's above his target, what's to prevent us from at least kind of gradually sliding into that recession in a way that doesn't blow things up like maybe the yield curve's other historical precedents did?
Yeah, I think that's a very insightful idea. And what we would say is, out of let's say the last 10 recessions before.
Oh no, that was the big one there. He was about to lay down the hammer. I could see it coming. All right, we'll take a sec, see if we can get Chris back online. If not, that's all right. We got more show coming up. It's a good start. We're going to talk some more bank earnings as well. We'll see if Chris can jump on for a second to finish the thought.
Yeah, hope BFE didn't lose a bunch of his gains. Very safely investing in gold and energy. That long list of stocks you have on his streams.
Of 1979 to 1984 than it is today. And so that, since housing starts are not going down as fast, they're going to have to cause this recession via other means. And we think that's going to be through credit growth. We see that, to your point about the regional banks that are having trouble. We're seeing credit growth slow down to below 1% year over year. And credit growth doesn't have to go negative to have a recession. It can just slow down. So we think the credit issue, and we also see, we see in these numbers where retail sales are weak, we're going to see anytime that we see dives like this in PPI and in retail sales, we're going to see a slowdown in personal consumption expenditures. And that we don't see that going negative. But again, since that's such a large part of the economy, any type of slowdown could drive the economy into recession. So autos, same thing. Auto rates are high, but people demand has been hard to satisfy over the last few years. So all these things are going to be down moderately. It may feel like a soft landing, or if credit gets worse, it could be very difficult. And so then there's also the stuff with China and their issues in their property sector that could feed into global growth.
So if I could summarize for a second, then we got to jump, but it sounds like what you're describing are what folks attribute to the lagged effects, elevated rates, pinching a consumer, an eventuality of kind of a strangulation in the economy, as opposed to like a big inflation shock again. Is that right?
I think that's a fair observation. I think it's going to come across broad base, and it's going to be this lag effect from higher rates that are real rates. And anytime we've had rates real like this for a sustained period, we've seen a material slowdown in economic activity.
All right. Glad we got you back. Thanks, Chris. Always appreciate your contribution here. Have a great weekend.
Thanks, Oliver. You too.
Likewise, Chris Becker, Chief Investment Officer at AZA Capital Management. Let's get straight into banks. Joining us, Chuck Lieberman is the Chief Investment Officer and Advisor at Capital. Markets kind of faded down from a strong start earlier this morning, Chuck. It seemed like we've already had second thoughts about those bank earnings. What do you think?
Well, there's no reason to have second thoughts about the bank earnings. Those were really good. Every single one of the banks, the big ones, all beat expectations. Net interest income increased. Guidance improved. They're buying back stock. There's nothing not to like here.
The companies that were troubled in the financial sector, some of them already went under during the regional bank fallout. What did we learn about the potential for that to linger in the space? Do you think that the assumption of some of those creditors and deposit bases has adequately plugged the leak in the ship, or are there still risks?
Well, there's still risks. Interest rates could still go up some more. But the fact of the matter is, time is the ally of those regional banks. They all have bond portfolios that are underwater, but every day that goes by, it's one day closer to maturity and closer to the value of those bonds working their way back to par. So time is their ally. As long as they can handle the rising cost of deposits, Deposit rates are under some upward pressure, but they're addressing that, and we're going to see how well they've addressed that when they start to report. But the big money center banks are in great shape. They attracted deposits without paying up. Anyone who wants more safety went there. And so they're making money hand over fist. And that's the message that we really got today.
Yeah, I'm looking at your notes here. I like the way you've kind of ranked them for us with the JP Morgan locomotive, kind of the implicit number one. Wells Fargo,
yeah, he made it out good.
Better than expected. A little comeback story there. And then
he's a great investor. I'm assuming it.
Kind of Wells Fargo, but more like
good risk management. I mean, most of his plays are very, very safe. The GME one was kind of unusual for him. From what I remember, a lot of his stuff was
if you want to hedge, I think a better hedge would
I mean, even that one he wasn't really looking for a short squeeze
short the regional
until he started to see stuff lining up and the potential for it.
The better off it is.
Right, he just saw the value, so
they want
safe value investing.
Capital requirements,
but that said, if you did lose 50%, doesn't matter what amount, losing a lot of money emotionally taxes you regardless, whatever percentage it is or whatever amount it is. It's all about percentages. I bet he did well.
Well, I think bigger is better, but I don't think that's why the regionals sold off. They all sold off. The whole market went down. So I wouldn't point to that. I think the regionals are going to have to prove their merit. We're going to see them starting to report next week. Once we have some information on how they did in the second quarter, we'll have a much better sense of their ability to grow going forward. But I don't think any of the regionals are going to be found to be in trouble. The ones that failed, those three banks, they were outliers and they were mismanaged, totally mismanaged in some cases, glaringly so to the point where you really have to wonder what in the world the regulators are doing. But nonetheless, the market still needs to see the regionals prove themselves.
Okay. And do you think we have a clear idea when we'll know, Chuck? Is there a way to know when the all clear has been waived for that group? Sounds like you're not convinced yet.
Well, I actually lean toward, I think the regionals are attractive because they've sold off so much. The market has priced them as if their world is going to come to an end. And I don't think that's going to be the case. The Fed's going to have to reconsider how it wants to regulate banks. It wants to raise capital requirements to make sure that they're all safe, but it has to be a lot more thoughtful about the process than it's been. It's been too rough, too blunt in the way it approaches these things. The regionals can't be allowed to sit on large large securities losses. They have to mark to market just like the large banks do, and that creates some problems for them. So I think they've got to shorten their maturities, take less risk, and if that means they're less profitable, so be it.
All right. Great conversation, Chuck. Glad we got you as well this afternoon. Really good contribution after the earnings. Much appreciated.
Thank you.
Chuck Lieberman from Advisors Capital. A nice clear ranking for us. The JP Morgan locomotive, Citi in transition, and Wells better than expected. Tom's got a little financial thought mixed into the options corner where we will look at a firm in a bullish trade. Next to Western Digital and
being run for Congress was definitely not on the bingo card. It ended up being, I think, his biggest investment before it went crazy, but I still think he was pretty well diversified. I don't think he'd gone crazy with how much capital he allocated to it. I know he added to it and it grew. I mean, certainly became his biggest investment at some point, but I remember seeing it on the list as his biggest investment, but it wasn't by, he was so diversified, like crazy. Add another play to the Data Farm. Data Farm members. Closed out of pretty much all of them last couple days. They starting to reopen some. It's at 2 tiers of membership now. The other tier is for I share my entries and exits on the option selling account. If you watched my last video I posted, I kind of introduced it. Need to do an update video for that one because I think we've closed out all those for 60 to 70% profit at this point. Man, what a choppy day on SPY, just grinding down this channel. No news on barbecue yet.
They guided severely lower, but the stock was beaten up. He saw a little bit of a relief rally after that earnings, which was below expectations, and the guidance was lower. And I think we're seeing some call buyers with some expectations that we're going to have some news about this merger deal over the next week. They want to get it done by August, so maybe that's why they're setting up as far as calls in there. July 21st, 40 strike calls. They bought over 2,000 of those. Average debit of 95 cents, so that break even of $40.95 over the next week. That's only about 4% above the current share price in there. Call volume, we typically don't see a lot of call volume in Western Digital. That's why I kind of brought up this only a 2,000 lot. But call volume is about 6 times normal daily average volume that we've seen over the last week of trading. So, yeah, expectations high. Maybe we're going to get some news on this potential merger deal and potential spinoff.
All right. Western Digital getting a little surprise love on a day where they are not loving tech in general.
Nope.
Kind of an odd winner, but to your point, a very specific story behind it.
Right.
Your bearish trade is in UPS.
Yeah.
And still kind of stuck. I feel like every time I look at the UPS chart, it's at like 175 or 180 bucks.
Think about this. The stock's only up about 6% this year.
Is that I'm sorry, was that Kevin Hinks there? Think about this.
No, I didn't say it like Kevin at all.
I guess that's what happens at the end of the week when you guys do the show.
I'm trying to emphasize my point about UPS. It's kind of stuck. Since that announcement on the 5th of July that the Teamsters said via Twitter that UPS walked away from the bargaining table. UPS shot back and said, no, we didn't walk away. They're just not negotiating.
Oh, okay.
Got a July 31st deadline date for a potential UPS strike. This could throw logistics delivery business into a tailspin And this isn't, historically they've had one or two strikes, but this is
We've heard a lot about these threats, though, from some of these big industrial companies, the rails, delivery, but the actors are doing it, and the writers are doing it.
Think about this: 340,000 potential impacted employees with a potential strike. They're not even having discussions right now. We're 2 weeks away, basically, from this July 31st deadline. Will the government have to get involved? That's going to be a concern. But we saw some unusual option activity, probably based on the fact that what if nothing gets done over the next week or two? So we saw some put buyers in here out in the July 21st cycle. So only a week till expiration. Maybe we'll get some more clarity over the weekend, maybe next week. But trader bought over 2,500 July.
Probably not a bad idea. I was surprised when you told me that.
Only 60 cents.
Hasn't started selling off already.
Just under 180, 179.40 over the next week. That's only 3% below the current share price in there. Now remember, this stock just last month was trading below 170. So it does have that ability to get down there, but it could be somebody hedging a long stock position in case this deal a deal does not get done.
They saw it, they caught you.
Short-term positioning to the downside. Put volume about 2.5 times normal daily average volume that we've seen over the last 5 trading days.
Might cause the stock to rally.
Not a bad idea if you're hedging.
Government bailing it out.
If you think that we're going to get some negative news on this deal.
Well,
EPS,
that would be
untouchable.
In the category of
stock
major
comes a government stock.
I think
government backed.
We've kind of moved
security.
on from the economic data as being a major catalyst.
Famous for sure.
Today's sentiment argues otherwise, but for the most part, we've been breezing through every print. Earnings, okay, we'll find out what happens, but earnings always beats. Companies generally don't miss.
Well, because they lower the bar mid-quarter, and that's.
But this is the type of stuff that's got major inflationary implications.
Right.
If you get strikes across multiple industries, suddenly you've got major wage.
Enticed to weigh out the money.
Then,
but
6 months from now, 3 to 6 months from now, maybe we start having another conversation about the demand side for inflation, which is kind of the inherent risk that people have been blowing off.
Yeah, and I think with that wealth effect coming into play here, where you've got the equity markets at or near.
People are going to feel comfortable asking for a raise.
Well, yes, exactly.
Give me a raise, or I'm going to go quit and start trading Bitcoin again.
3.7% unemployment rate, 3.6% unemployment rate, tight labor market. Wages are going up. Inflation's still going up, but that's coming in a little bit. So yeah, demand might be an issue. If people are more comfortable spending, they're not losing any value on their house either. So
true.
Yeah.
All right. Thanks, Tom. UPS, a little bit of a surprise factor going forward with labor. Thanks, Tom. Got an update from Jenny on the toy business for Funko, not Barbie or Mattel.
Funko.
And then we're going to talk some trading in the bond market, of course. Larry Shover.
Have they ever talked about Funko on this channel? Oh, Funko's sold off. GME's totally buying Funko. August 4th. 190, 180. It's a pretty tight strangle. Could even go further. CEO departure. Good chance for GME here. Wish there's more liquidity on those options. Nice little premium sell. That's true. The cap's only 412 million. Dude, GME should buy this. For leaps on this thing. Look at that spread. 5 cents to $2.55. Spreads are awful. Falling with a fatty. Total candle to VWAP. Let's not get excited here, Seaman. Barbecue's coming down. Can't get the so the puts, you're talking about August. First Friday in August, looking at 180 put. Only 24%, which is probably normal. It's probably elevated, but yeah, still very low. 24% IV, 25. Your 190 call, 22%. So starting to rally a little bit. Oh, that's next June. Spread's way too loose. Maybe this January. Okay, I got some Funkos. Snipe the chain a little bit. It's a good opportunity for GME to buy it. Things come down a lot with this new CEO. Chain's pretty illiquid, so able to find a good price. Price come down here a bit. I got the January 15 calls. And a big gap down from earnings. It's low IV, but I don't think it's like lower than normal. BAOS is halted up. This one's Chinese. Yeah. Oh, this is lower than normal? Current IV is 27%. I'm not getting historical data on E-Trade on it for some reason. Yeah, I mean, if it's normal, I guess that's would be a good opportunity. Not elevated. Last 10 minutes, here comes the Fugazi. Yeah, it's interesting actually. It hasn't been. It's not higher. $190, $175. Nice. Slightly biased to the downside. What'd you get? August 4th? Dish kept coming down. 7% down on Dish.
right now, especially with a strong economy. If the labor market's still chugging along, if
5 minutes left for the
earnings are
squeeze.
growing, the Fed can't afford to take their foot off the brake. Otherwise, you see inflation pressures continue to bubble. So I think we'll continue to see a lot of volatility in the near term. The good news is that inflation's coming down, but given the better than expected economic data pretty much across the board, that's likely to keep yields probably at the high end of this range.
Okay, that's an important point, that within the range, we should expect to stay near the higher end. What did you make of the way stocks responded to sentiment, Nate? I mean, kind of the same thing we just talked about, but framed a different way. It does seem like that print this morning threw us off a little bit.
Is this it? Is this the last 3 minutes where you can buy barbecue?
Yeah, I describe it as a
Before it's worthless or very valuable?
Kind of tracking a little bit better than expected, as evidenced by the price action this week. You know, if Colin is mentioning that we might remain towards the higher end of the range in terms of those bond yields, let's keep in mind on that valuation front that we're at a 19 forward PE on the S&P 500. The 15-year average is 16 basically, or 16.9. But let's also keep in mind that the 10-year had an average yield over the past 15 years of 2.37%. At 3.8%, that even makes the forward PE of 19 even more expensive on a relative basis there. So that's why I feel like, you know, is it possible that we can push this 19 up to a 20 or a 21? Yes, but you're going to have earnings or some kind of other catalyst that's going to come into the equation, because it feels like we're just a little bit baked right here. And let's not forget, I can go out there and grab, you know, 4 or 5% in fixed income if I want to go to the sidelines.
Okay, that bid you can still get in bonds and that return seems like it should limit the valuation potential of stocks, right, Nate? Because it's per share, basically. Flip it on its head, you got a yield.
Absolutely, it's risk reward. So, you know, the higher the yields, then basically you have that relative valuation that you should get. Equity multiple needs to come down as those comparable, quote-unquote, risk-free rates come up. Number
5%
two,
more than the upside problem, 7% more than the downside problem.
For corporations, and number three, for longer-term assets such as tech.
By expiration.
Take that multiple down even more because of the discounted free cash flow models. And so those higher yields, historically, they're supposed to have a pretty big impact on risk assets such as equities, but this market has been pretty resilient given the current multiple.
No, true. And I've personally been very surprised at the refrothing that's been possible. I think AI was kind of the black swan in a way to spur some of that valuation growth again. Because you'd think that with the way rates have moved over the last 2 years, that there should be some kind of permanent impact when they stay elevated. Speaking of elevation, the stickiness of inflation expectations from sentiment, Nate, or rather, Colin, I want to come back to that for a second as it applies to bonds, because the framework and the explanation I hear a lot right now is that markets are rallying and life is great and markets are good because inflation's done as a problem. To me, that seems a little bit off. It seems like it's more the Fed's not forced to
know what
go
that sound
nuts
means.
against inflation for the time being. What do you think?
Yeah, I'd say they're not forced to go nuts because we are seeing plenty of trends that inflation is moving in the right direction. Like you alluded to, if inflation's coming down and wages keep growing, that means that your real earning power is growing. The problem, and here lies the rub, is that if the economy is still growing and consumers are still spending because inflation's coming down, that means that inflationary pressures can still bubble under the surface. And the Fed then maybe needs to act more, or at least hold at its peak for a while to make sure those inflationary bubbles don't.
No bell.
Sorry, my headpiece was coming down.
You guys are lucky.
So I think that in and of itself supports.
I got back into
the case
barbecue
for a prolonged hold.
for the exposure.
And I made this point before, and this is the risk that we see with specifically the corporate bond market. And Nate,
All right.
points we've had over the past 10 to 15 years. Periods where yields have risen, especially for corporations, but they've since retreated, meaning there was kind of like an opportunity to then borrow if need be down the road.
You wanted the bell? No one's fired, man. You guys need your jobs. You're about to lose all your money in barbecue.
And that just will weigh on corporations. There's no
It's about to go poof.
right now if you're a corporation who needs to borrow in the market. Yields are high.
I joined back in.
Stay high for the time being.
All right. Well said. higher for longer, implications for stocks, then should linger. Thanks, guys. A good perspective on the data and the response to it this week. Nate Peterson and Colin Martin from the Schwab Center for Financial Research. The NASDAQ ends the day flat.
Smaller position than what I've had.
Obviously a fade from the highs.
Much smaller.
At least the Dow stayed up as
Don't lose all your money on the strangle.
did carry the sector with
9% one stock.
down. Financials got dragged.
Yep, there we have it. There's the week, you guys.
Discretionary. It wasn't a great day for
5 pretty rippy this week. Cup handle played out, and we're at yearly highs. 50% of your account? How many contracts did you get? Do you have these RSI divergence back here? One with here and here. Man. It's due for a pullback even if it does want to keep going. Proper gap fill. All of them? Nice. Barbecue up on the week a bit. Kind of making this handle still. You got your cup, you got your handle. This handle's looking like kind of just another cup though. Higher lows, higher highs. We'll see. We've got we do have a channel we're in. Maybe you can see it on the 4-hour. See what happens this weekend. Or today actually, huh? Is it today? Yeah, today. Too exciting not to grab it. So we'll see. What's your stores I can retire? Leverage 2023 colorized. Yeah, the IV is low. Surprising it hasn't been elevated. Well, that's what I got, guys. GME's down 2%. We'll see if it bounces again on this level, or if it's back down to 20, maybe even the teens. Neg ended up working out pretty well. And close out at Beyond. Opened up Funko. Closed some Neg. Closed Beyond today. Have a good weekend, Guts. Thanks for the dono today, man. Appreciate the generosity and the support. Hopefully some bad news. We'll see. Yeah, you're a little weighted to the downside. Thanks, guys. I appreciate it, though. What a week. What a week. I think it's wrapped up. I mean, maybe not wrapped up, but seems like we should have information by Monday of what's going on with barbecue. So, thanks, Molava. Thanks, Dink. Thank you, guys. 37 likes on the stream. Hope you had a good week. Have a good rest. Chill. See you guys on Discord. Linked in the chat if you haven't joined. Also our Twitter. See you on there as well. Thanks, guys. Have a good weekend. Be good. Okay, peace out.